All right. So I think now I would be live, audible, and visible to everyone. So, guys, are you all there? Very good morning. Welcome to this session. Are you all able to see me, hear me? What is the status? Please tell me. Very good morning. All the live people, welcome to the session. Recorded people, welcome to this amazing video. Yes, so what this video is about. So as I say, we have a series of chapter-wise concept and important question revisions in full English language. So this is one such other chapter we are covering. So this is about equity and business valuation. Sir, in the outscanner or in the concepts notes, let me tell you what this video is. What this chapter is actually. So if you go to the study material, people, you will find that there are two chapters. One is security valuation, another is business valuation. The security valuation has been broken down into two parts. One is this particular part, which is fixed income security, and another is this part, which is equity security. So equity security and business valuation chapter are merged together to name as equity and business valuation. Yes, the other three chapters, other three securities like preference share, bond and money market securities, which require the other thought process, which the weight you think for these securities is different from what you think for equity, which is why they have been grouped together to form another chapter called as fixed income security. So in this video, we're gonna do equity valuation, business valuation, right? So business valuation entirely gets done. From the securities valuation chapter by institute, equity gets done. For fixed income securities, you're gonna have another video, right, which we will record soon, take live soon. This is what the chapter we are covering. Perfect. Great. So let me very quickly show you. In these notes, I'm going to use two files. In this video, I'm going to use two files. One is the out notes, which is our concepts notes. Another is outscanner, which is the question bank. So this is the sample of out notes that you see here, which has all the concepts presented in the form of tables, timelines, charts, structures, rather than boring text. It makes your learning first time easy, effective. You are able to retain it for a longer time. You are able to recollect it in the exam very quickly. These are the out notes, the concepts notes. Second is the question bank, which is outscanner. Let me show you. This is the outscanner. So the outscanner has compilation of all the practical questions and MCQ from our TP exam paper study material or any other publication of institute, which means this is also really comprehensive. These two books are the same books that we use in our batches. The same is available also for you. You can download the soft copy from the link given in the description. You can also buy the hard copy from the link which is there, right? Choice is yours. So perfect everyone, let's get started with equity and business valuation chapter. So I think first of all, I am going to show you, just a second. Just a second, wait. The first thing that I am going to teach you are certain basics which will be of use in this particular chapter and across the entire AFM. The first thing in the basics, people, in the class is creation of income statement. You start, okay, so we may end up spending some 15-20 minutes extra for that, okay, but once you get those basics, it'll be of very use to the entire AFM in this particular chapter especially. Yes, so are we all ready? Shall we get started? And before I start, let me tell you, you will have to, everyone in the class, please like this video, subscribe the channel so that other similar updates I can deliver to you people, and obviously it motivates me to do better for you. Yes, shall we? Everyone get started. So come on. Sir, when it comes to creation of income statement, you start with revenue. From the revenue, COGS, which is manufacturing cost, gets deducted. So what you get is called as gross profit. From the gross profit, the other two operating expenses gets deducted, which is general admin and marketing distribution. Now, assuming all these three expenses does not include the amount of depreciation, the profit that is arrived is called as EBITDA. Earnings before interest, tax, depreciation, amortization. So it is my operating profit, but cash operating profit, because non-cash expenses have not been deducted so far. Fine. Then from EBITDA, when you deduct depreciation, what you get is EBIT, also called as operating profit, right? This is called as operating profit because from the revenue, when you deduct these four cash and non-cash operating cost, what did I say? Cash and non-cash operating cost, all these four costs are collectively called as operating cost. So from the revenue, when I deduct operating cost, the profit that I get is called as operating profit, which is EBIT. Now you know the sequence. First interest will be deducted, we'll get PBT, then tax will be deducted, we get PAT. From this PAT, first preference dividends will be paid. The earnings which are available to equity shareholder are called as EAS, which is from which when equity dividend is distributed, rest of it, people in the class, is retained with the company, called as retained earning, which ultimately become the part of the balance sheet. Yes, very basic, clear. Sir, this PAT can also be calculated sometimes, not in this particular chapter, but when you go to the chapter of advanced capital budgeting in this format. This equation has been discussed out there in that particular video, not right now. Sir, calculating EPS. Common sense, what is the total earnings of equity divided by the total number of share of equity? EAES divided by PAT. But imagine that if the preference dividend is not there, so EA is divided by number of share. If the preference share is not there, do you agree PAT minus 0 preference share is EAS? So in that case, PAT and EAS become equal, and which is why they can be interchangeably used in the course. Sometime instead you would say EPS is equal to PAT divided by N. Correct? Because there is no preference. Sir, book value per share, the next thing you all should understand, book value per share, everyone, gives you the total value of equity shareholder as per balance sheet. You can have two approach. Either you follow equity approach, the total value that they have in the balance sheet is their share capital, their reserve surplus, any kind of retained earning, minus if there is any unamortized asset in the asset side of the balance sheet, that is to be deducted. Similarly, you can also follow asset side approach. Once you have all the assets, all the real asset, not the fictitious unamortized assets like preliminary expense, excluding these unamortized expense, you take all the assets. Who will have the first claim over the assets are the outside liabilities like creditors, the lenders who have given loan to you, etc. Then we'll have the claim of preference shareholder, and whatever is then left belongs to the equity shareholder, called as equity shareholder fund. In whatever way you calculate, the answer has to be same, because the total of the balance sheet is always matching. Correct? Fine, sir. Sir, return on equity. Return on equity is really a simple way to calculate return, which is all based on financial statement. Sir, one simple thought process of return calculation I have always shared with you, which says in the denominator you always take the amount of capital invested, and in the numerator you always take the income earned on that capital. So if I have to calculate the return of equity, then in the denominator I should take the funds invested of the equity in the business, and I call it as per financial statement, that is called as either book value per share or equity shareholder fund. By investing these amounts in the denominator, how much could the company or business earn for them? Sir, it is either EAES, the totality profit earned for equity shareholder, or maybe on a per share basis you can call it as EPS. So return on equity is the ratio all based on financial statement. Whatever be the price in the market, doesn't matter in ROE, it is all based on financial statement. Denominator is the amount invested of equity, numerator is the profit earned for equity. Either you think on totality basis, or you may call it on a per share basis, which is EPS divided by book value per share. Yes, I hope all of you are able to connect to what is going on. Return on capital employed. On a lighter note, you can just see the formula at your home. right? Where equity talks only about the equity capital return on capital employed talks about the return on the entire capital which gets employed in the company, equity plus debt plus preference. So in the numerator, you take the profit which belongs to everyone, and EBIT is that profit which belongs people in the class to everyone, correct? Then is market price per share. Obviously, it is the price that prevails in the market. It is the actual price. The valuation that we do is the intrinsic value fair price. This is the actual price. And when you look at the total market price of all the shares, we call it market value or market cap of the company. There are two types of market cap that you need to understand, full and floating. The total market cap or full market cap is the total value of all the shares of the company, total market value of all the shares of the company. Whereas a free float market cap, everyone in the class, is the value of only those particular shares which are being traded in the market, which are held by public in general, which are not held by promoters. For example, a company has 1000 share where promoter of the company holds 700, we hold 300. So value of those 300 shares is the total value of those 300 shares is the free float market cap. That's the difference between full and floating market cap. Correct. For instance, there are 1000 share of 15 each, total market cap is 15,000. There are 300 share of 15 each which are freely floating, 4500 is the free float market cap. For free float, there is one more way to think. It's like total market cap is 15,000, and of that total market cap, 30% holding is public in general, free float. So 15,000 into 30% give me the same number of 4500, which is calculating market cap. Next, few ratios. First, MPS, a ratio calculated on MPS, price to earning ratio. The name has the formula. Price is MPS, earnings is EPS. So MPS divided by EPS is the P ratio. Examiner can give you MPS, EPS, ask for P. Examiner can give you P and EPS, ask for MPS. Or it may give you P and MPS and ask for EPS. Any combination is possible, that you must realize. Similarly, one more ratio called as price to book value ratio, which may be used, is MPS in the numerator where book value per share in the denominator. As compared to every 1 rupee of book value that the company has, how much of every 1 rupee of equity value, equity shares value that a company has, how much price people are ready to pay for that in the market. So when it comes to PE ratio, MPS, market price per share, these are the ratios these are the parameters based on the market. But ROE, book value per share, EPS, they are all financial statement based parameters. Sir, one thing I would want to tell you, the total value of the equity as per market is market cap, as per books or financial statement is equity shareholder fund. On a per share basis, we call it MPS and book value per share. Yes, cool. Yes, taking you all ahead, sir, dividend and basic other related things. If you have the total amount of dividend which gets distributed or paid divided by the number of share, give you per share dividend, calling as DPN per share. Yes. Now, sir, this DPS can also be calculated in percentage terms on various different bases. Dividend as a percentage of face value is called as dividend rate. Dividend as a percentage of market price is called as dividend yield. And as a percentage of EPS is called as dividend payout ratio. For example, DPS for example is 2 rupee. Company is planning to distribute 2 rupee of dividend where the face value of the share is 10. We will say that the dividend rate is 20%. Or you can also say it otherwise, if I have the face value and the dividend rate, I can calculate the amount of dividend per share. Very similarly, sir, if I have the amount of dividend and if I have the amount of market, like the MPS of the company, dividend yield can be calculated. Company is planning to distribute 2 rupee of dividend where the price of the share of the company in the market is 100. Face value was 10, price is 100. We call the dividend yield to be 2%. So if I have the dividend yield number with me, if I have the MPS number with me, I can find out the dividend per share. Similarly, 2 rupee of dividend I'm planning to distribute out of 5 rupee of EPS I have earned, dividend payout ratio is 40%. So if 2 is being distributed, then can I say retained earning per share is 3, which is retained, on an EPS of 5 give you 60%, which is retention ratio. So 40% plus 60%, the part which is paid out is payout ratio, the part which is retained is the retention ratio, and the total of which everyone in the class is 100%, which is dividend payout ratio plus retention ratio. People in the class, please tell me, are you all there? Come on, come on, come on. Are you all understanding what is going on? Are you people able to process what is being taught? Are you comfortable with the language, with the speed, with the way we are learning the things? I'm trying to make it really comprehensive. In fact, let me tell you, with this revision video, you are going to recollect all the concepts that you've learned. You are going to have the applications of those concepts in the practical question. That is the approach that we're going to follow. Yes, everyone? So great, sir. Moving ahead, a small thing I have to tell you, it may be of use in some question or may not be, but sir, if you have a come dividend price, meaning to say the share price is there, company announces the dividend, so amount of dividend is somewhere integrated in the share price. Because investors in the market know that if I purchase the dividend, I will become the owner of the company and I will receive the dividend from the company. But on the day when company decides to pay the dividend, right? I'm not telling it specifically about X dividend date, etc., etc. But on a lighter note, using common sense, I want to tell you, right, that on the day when company pays the dividend, then the amount of dividend gets excluded from the share price, and the share price falls by the amount of dividend theoretically, and the share price become X dividend price. For example, share price is 110 here. 5 rupee of dividend distributed, it will become 1.105 here, and then it will continue to grow or fall in the market. Right? Next, basics are certain ratios. Those ratios are of compilation. In various practical questions in the entire AFM, there are different ratios which are being used. As in when we come across those ratio, right, we write them down in the outnotes at a particular place so that they can all be compiled. One day before the exam, you won't have to worry that where was that particular ratio or this particular ratio. You have all your formulas here, you read it, exam day morning, you're all sorted. Perfect. So next, when I talk about the required rate of return, when it comes to discount any cash flow, whether it is the chapter of equity or fixed income or business valuation or wherever, when it comes to, or in fact capital budgeting, whenever it comes to the discounting rate to discount any cash flow, the discounting rate is always the required rate of return from that investment, from that project, from that cash flow. You invest in the equity share, how much you need to earn from that share become the discounting rate for valuation. Right, you invest in a project, capital budgeting project, right, the rate of return you require to earn from that project will be its discounting rate. But how do you calculate the required rate of return? Basically, in common sense, the rate you require to earn, the minimum rate you require to earn depends on what is the risk-free rate in the market. Which means someone if invest in the government of India bond, which is the risk-free security, if you invest in that risk-free rate security, how much is the return you will earn? And over and above that, you would want to earn a risk premium. Meaning to say, if there is no risk, I am earning this much. So if I take risk, then there must be something extra I should be able to earn for that extra risk I take. So extra return for extra risk taken is called as risk premium. Now the risk-free rate which I am talking about automatically has two components, the real risk-free rate and the inflation premium. Right? When I say a rate of return or a cash flow, that is always nominal. Nominal, the word nominal means the actual that exists in the actual world around you. When I go to SBI today, you and me go to the SBI, ask the bank manager what is the rate of return on FD, he will say 7%. That is the rate we will actually receive. That is a nominal rate of return. From that, if you eliminate the effect of inflation, we call it the real risk-free rate of return, which means overall, any rate of return for a risky security comprises of three elements: the real risk-free rate, the inflation premium, and the risk premium. If the security is risky, you include risk premium. If the security's cash flows are, or the project's cash flows are nominal, you also include risk inflation premium to it. Correct. What exactly you wanted to say, sir? This detailed part you will learn in the advanced capital budgeting, where we have the discounting of real and nominal cash flow. Cool. Expected rate of return, basic common sense. How do you calculate P1 minus P0 plus D divided by P0? This part, P1 minus P0 divided by P0 is the capital gain yield. D divided by P0 is the dividend yield. Sir, that's what I've taught you, right? DPS divided by MPS. Because price today is MPS, D is the DPS. So DPS divided by MPS is the dividend yield, where this part is capital gain yield. It may happen to us that institute give you P1, P0 and D and ask you to calculate expected return, or it is possible, which happened in the portfolio management and also in a particular question of mutual fund, that institute give you dividend yield and P1 and P0. Now what do we do? Sir, dividend yield is given, keep it as it is. You calculate P1 minus P0 divided by P0 as capital gain yield, add them to find out the total yield or the expected rate of return, which when you go to the practical, the revision videos of those particular chapters, you will automatically find it. So in the description, I'll give you the link of the playlist which has all these videos compiled for you. Sir, expected rate of return gets done. Internal rate of return is basically a technique which I'm not going to teach you in this video, but the common sense is really simple. I have an initial outflow of 100 rupee. I will get 60 and 70 in the next 2 years. So basically outflow is 100 and inflow is 130. So this is very clear that I am earning something, because what is going out is a lower number, what I will receive is a bigger number. What is the rate of return that I am earning is called as internal rate of return. How do you calculate it? Sir, the rate at which the present value of 60 and 70 is equal to 100, that is the rate of return I am earning. So sir, 60 is to be discounted by a particular rate for 1 year and 70 is to be discounted by a particular rate for 2 years, right? And what should that rate be? The present value of 60 and 70 become 100, that we need to back calculate, called as IRR, the rate of return which you would be able to earn if these are the cash flows. The way you calculate is really simple. Mathematically, you cannot simplify the equation. A better way is trial and error. Make a random guess that what can this R be. For example, you make a guess of 18 and 19%, and the present value turns out to be 101 and 99, right? 899. But you know that the present value that I need is 100. So common sense will be like, if you discount using 18%, the present value is 101. If you discount using 19, the present value is 99. So what should this discounting rate exactly be if I want the value of 100, for which I have taught to you a shortcut in the class. Sir, I was not planning to first cover it up, but then I thought I must, so that you get everything which is needed to you. So there was a shortcut formula that we had learned in the class which said this minus this divided by this minus this is equal to this minus this divided by this minus this. R minus 18 divided by 19 minus 18 is equal to 100 minus 101 divided by 99 minus 101. If you create this equation, if you learn to create this basic thing, then in the entire AFM, whenever it comes to interpolation, you'll be able to do it. Whether fixed income securities calculation in the YTM, or whether Black-Scholes model where the values are not precisely given and you have to interpolate. In the entire AFM, in the entire CA final, in your entire life, in fact, if you want to use this formula of common sense, you can use confusion-free formula, correct? Wherever this value is positive, negative, increasing, decreasing, any combination, this minus this divided by is equal to this minus this divided by this minus this. That simple equation, if you frame, you realize in the entire equation only one number, which is R, which is missing. You can try to solve it on the calculator directly, really easy. Sir, you calculate this minus this, m plus, you calculate this minus this, divide equal to, into memory recollect equal to, which means entire part gets solved. Multiply it with 1, add 18 to it, and you will have the answer 100 minus 101.12 m plus. Then 99.85 minus 101.12 equal to, divide equal to into memory recollect, right, multiplied by 1 plus 18, give me 18.88188, which is 18.88% as the discounting rate. Meaning to say, if the discounting rate is 18.88, then the present value of 60 and 70 for at 0 point will be equal to 100 means the rate of return being earned on this cash flow is 18.88%. That is a rate which is automatically annually compounded. That was IRR. The time value of money things I am not covering in this video. Sir, the cash flow concept of real nominal you will automatically learn in the video of advanced capital budgeting. And now I am going to take you directly to the concept of equity in business valuation. Yes, boss. Yes, boss. Are you all please, everyone in the class sitting here, if you're watching this video live, then please come to the latest point. It is 9:39 in my watch right now. Time is 9:39. Suppose you are watching it and it is 10 p.m. or 10:30 p.m. You can consider coming to the latest point. I think you'll be able to grab whatever goes on live. This recorded part you can watch later. Come on, all the live people, kindly respond to it. And if you have still not liked the video and if you feel that the basics are really clear, then this video now at least deserves a like. So a genuine request at the end of the video, if you feel that the video has really helped you, then please comment down whatever are your genuine feelings for that video. Reason is really simple. When someone who's new to the video will watch it, he doesn't have that confidence of watching because maybe he has not known me. Your comments help him to gain that trust that okay, the content that I'm watching is is really comprehensive one. It will give me the clarity that I need. That confidence you can offer to him. Yes, sir, starting with the chapter. In this chapter, there are different ways to value a company. First, using the dividends of the company, then using its cash flow, then using its asset, then using its earnings, and then its relative valuation. Perfect. Sir, and there are other topics related to valuation, starting with the dividend-based valuation. The underlying logic of dividend-based valuation model is really simple. That value of any asset today, at today point, at 0 point value of any asset is whatever cash flow that asset will generate. The present value of all those future cash flows is the value of asset today. That is the common sense of finance called as fundamental principle of valuation. The value of an asset today is the present value of whatever future cash flows that asset will generate discounted at its required rate of return. From that cash flow, whatever is the required rate of return, you discount using those rate the future cash flows, and the value arrived at 0 point is the value of an asset. It applies to fixed income or any other concept of finance. Yes, sir, first thing. When we talk about equity, what are the future cash flow you receive? When you invest in the equity today, the future cash flows you will receive is the dividend of the company. And after a point, when you go to the market to sell that share, so that sales price that you receive, is also a cash inflow you will have. So present value of those dividends and sales price at 0 point discounted at the required rate of return is the value of equity as per this simple model. But sir, why are we doing the valuation? It's already there in the market, the value. The value which is there in the market is its actual market price, MPS. The value that we calculate is what should be the value, what is the fair value, what should be its price in the markets, its true worth is called as intrinsic value, fair value, equilibrium value. Correct? Fine. Sir, suppose I have calculated the value called as intrinsic value, which is different from the price which is already there in the market. So what can we do? Using the MPS and intrinsic value, you can compare. Using MPS and intrinsic value, people in the class, you can compare the things and come to the investment decision. For example, price in the market, which is actually there, is more than the intrinsic value, which means it is more than the price that you think it should be. Do you feel that the share is overly valued? And something whose price is more than how much it should be, it is overly valued. And something, if it is overvalued, would we ever buy it? No, we will rather sell it. Similarly, the price in the market is lower than the intrinsic value. We call the security to be undervalued, we buy it. And if the two things are equal, we call the security to be fairly valued, and everyone in the class hold it. Yes, theoretically at least we hold it. Sir, there can be two possibility of situations that we can have in the exam. Possibility one, we invest in the equity share, we hold that equity share for a limited period of time, calling it to be the definite number of year holding. So in that case, when you invest in the share today, suppose you are planning to hold it for 5 years, then you will receive the dividend of the next 5 years. Yes. And at the end of 5th year, you will also receive the selling price. So present value of all these future cash flows, the value for us today. So present value of dividend of first year, second year, similarly till 5th year, and sales price at the end of 5th year. These are the future cash flows for which as PV is to be calculated. They are discounted at the discounting rate called as cost of equity. Boss, cost of equity is the discounting rate that we use to discount the equity related cash flows. We will talk about the cost of equity in the next 5 minutes. Perfect. Sir, if the shares holding period is for a very longer period of time, which means till infinite period of time, indefinite period of time, so in that case, it shows that we have no plans to sell the share as of now. So there is no plan to sell the share, then you will not receive the selling price, correct? Then what will you receive? You will continue to receive the dividends of the company till an infinite number of years, which means right from D1 to D2 till D infinity, all those dividends, people in the class, all those dividends you will discount to present value, bring them to present value where discounting rate will be KE. Sir, if we have to discount 6 cash flows, then it looks practical that we will create the table of cash flows, we will multiply the present value factors to it, we will calculate discounted cash flows, add them up. But if something which goes till infinite number of year times, which is more than even 1 lakh, 1 crore, how many dividends will we discount? Sir, when it becomes till infinity, you have to make use of maths and you will have to use dividend discount models we will talk about. Correct? So the first thing to learn will be the question is under which category, definite number of year or for indefinite number of years, right? If it is definite, you can directly discount. If this is indefinite, we will have to use the DDMs that we will learn, right? And the next thing we need to understand is the cost of equity. Meaning to say, you are saying that the discounting rate will be this, right? You are saying that the discounting rate will be this. So let us first of all learn to calculate that discounting rate before we discount. Just give me a minute, let me look at the comments. Hello sir, I've purchased AFM full English regular class and completed 5 lectures only. I'm applicable from May, September 26. Should I directly jump to the revision in case I'm unable to complete all? No, that's not suggested. Rona D'Souza, that's not suggested. As a first timer, you should watch a regular batch, which is already an exam oriented regular, right? But in the worst case, when it comes to the situation that you feel that I will have to ultimately leave everything, so in that case, you can opt for power. All our regular and fast track batch students get a free access to the power batch, which is a short duration 75 hours batch, which has a detailed discussion of all the concepts and practical application of those concepts to the questions. So you can claim that free access, talk to the team at Fast, claim that free access, watch the lectures of from those chapters. But not all the chapters, only the chapters which are easy like mutual fund, mergers, acquisition, advanced capital budgeting. But the chapters like foreign exchange and derivatives especially, and in fact to an extent even portfolio, these 3 chapters especially, you should consider watching only from the regular batch, then only you would be able to process them in the exam. Are you getting me? Please. Bringing you all back to the discussion, just give me a second, please. Just give Perfect. Fine. So we are back. So cost of equity, if I talk about everyone, there the original way to calculate KE is CAPM, which is RF plus beta into RM minus RF. Do you people know? RM is the return from market, RF is the risk-free return. Sir, how do we know the return from the market, boss? To the market, what represents is called as index. For example, NSE, National Stock Exchange, which is a stock market, their index is Nifty. BSE, Bombay Stock Exchange, which is the stock market, their index is Sensex. So the return of market or the return of Nifty or Sensex or any other index is considered RM. Similarly, RF, the government bond yield, the return that government of India or government of US on any bond offers is called as risk free rate of return. So RM minus RF, if you have multiply it with your company's beta, which represents your company's risk. As I say, people in the class, this detail of it you will learn in a portfolio management, a very detailed discussion on CAPA. But RF plus beta into RM minus RF is the required rate of return. Fine. Sir, second way to calculate, I mean, this is not a choice. Only if the data of RM, RF, beta is not given, when you are not able to apply method 1, then you apply preference 2. What is that? D1 divided by D0 plus G is the way to calculate cost of equity. And in the worst case, if even this is not possible, then earnings yield is the formula of K. Whenever you hear this word yield, yield always means a return which is based on the market price. Dividend yield is DPS divided by MPS. In the fixed income security, you have this word called as yield to maturity, which is also based on market price. In fact, earnings yield is EPS divided by MPS. How much is the earnings of the company as a percentage of market price that I invest today is earnings yield. Sir, it looks similar to the formula of PE. PE actually was MPS divided by EPS. So can I say KE can also be calculated using the third method as 1 divided by PE ratio, correct? Now one particular thing I want to teach you now, tell you now. The logic of it cannot be discussed now, but you have to just on a lighter note accept it, because it has a very detailed discussion done on the page of portfolio management. Cool, it's there in the discussion that we have done in the portfolio management. It's there in that video. Sir, when the price, which is P0, is equal to the intrinsic value, we call the share to be fairly valued. This is agreed, sir. Cool. Sir, we read about the two terminologies. One was required rate of return, another was expected rate of return. Is there a difference between the two terminologies? Absolutely, yes. One is how much I need to earn. One is how much I need to earn. It depends on the risk involved. The higher the risk a particular cash flow has, the higher the return will be I would want to earn from that cash flow or that investment. Which is why you have the risk premium here. More risk premium, overall a more required rate of return. So one is how much you need to earn, second is how much you think you will be able to earn. To pass CA final exam, you need 50. That's your minimum required. But how much you think you will be able to earn depends. It may be 80, 60 or even 40. Similarly, you think that TCS share is going to give me a 15% return. How much will it be able to give to you is the expected rate of return. But how much you need from it may be 18% because of the risk involved, or maybe 12% because of the risk involved in it. Getting it? Required is different from expected. Expected depends on how much will be the price of the share, and accordingly based on that price and dividend, how much do you think I'll be able to earn, right? Although the two rates are different, but if the share is fairly valued, very important line I'm saying, if the share is fairly valued, then expected rate of return and the required rate of return are considered equal. How much I require, the same I will be able to earn if the share is fairly valued. If the price of the share in the market is same as what it should be, then the rate I require to earn will be same as how much I think I'll be able to earn. This relationship, sir, can you justify? Not in this video. In CAPM, we have done a detailed discussion. In portfolio management, we have done a detailed discussion on CAPM, which calculates required. And that particular required calculation that we have done there, out there on page 121 of the outnotes, we have explained the logic behind this, and that's what you can cover from there. Right now, you just have to accept it. But sir, why are you teaching us here? Sir, examiner will say calculate the value of share if these are the dividends and the required rate of return is this. Fine, you will discount it using required rate of return. Examiner will say find the value of share if the expected rate of return is this. So that common sense people in the class, you will have to apply that even if examiner give you expected rate of return, you will have to use it as discounting rate, because if the share is fairly valued, required is equal to expected and it can be used as the discounting rate. Logically, only required is used as discounting rate, not expected, but with an assumption of fair valuation, the two become same, and which is why they are interchangeably used by the institute. Similarly, institute also uses the word price and intrinsic value interchangeably. It will give you data and ask you to calculate price. Whereas price is something which actually prevails. What we calculate is always intrinsic value. But if the share is fairly valued assumed, the two will always be equal. Correct? Fine. Moving to the first model, which is constant dividend model. Sir, what are you saying? If the dividends are till infinite number of years, people in the class, if dividends are till infinite number of years, do you agree? I have to discount them using some maths. So it actually depends on the pattern of the dividend. If the amount of dividend is same every year, constant it is every year, or they have a zero growth, in other words I can say, then it gets covered in the constant dividend model or zero growth model. Another possibility of pattern is that dividends of the company grow at a constant rate every year. Sir, it is 10 rupee in the first year. In the next year, it increases by 10%, become 11 rupee. So sorry, 10 rupee increases by 10%, become 11. In the next year, it again increases by 10%, 12.1. This way, the growth till infinity continue to be 10% in the dividend. That is the pattern. If it is, we use constant growth model or Gordon's model. So depending upon which exact model will be followed, which exact formula will be followed, depends on the pattern of the dividend. If the dividend pattern is a variable growing pattern, for example, year 1 it is 10, but after that it grows by 20% to 12, then it grows by 10% to 13.2. So if the dividends are growing variably at different rates of growth, then this is constant growth model, also called as then it is solved using variable growth model that we will learn on this particular page. Are you broadly clear? So now let's take it one by one. A really, really easy and highly interesting thing if you are aligned with me. If you are there with me, you are going to like it that I can 100% commit people in the class. Please look at this, what it says. Zero growth model, constant dividend model, which means the amount of dividend you will receive till infinity is constant. Fixed. Can you feel the annuity? Yes, sir. And what is the present value of annuity? The amount of annuity divided by the discounting rate. This is the basic time value of money formula. For us, the amount of annuity is D1 divided by the discounting rate is KE, and the present value of all those future dividends calculated using this formula D1 divided by KE is P0 or intrinsic value 0. They can be interchangeably used. Point of observation, which is the first dividend I discount is D1. Although there is no growth, to D1, D0, D2, everything is same. But the objective of writing D1 is the giving you conceptual clarity that the first dividend this formula discounts is D1 and not D0. What this formula does is the present value of future cash flows, which starts with D1, not D0, which ends to D infinity. So from D1 to D infinity, everything gets discounted in this formula. This is first way. Second, If the growth in the dividend is constant forever, the formula is used as d1 divided by k minus g. The formula all of you have seen to calculate intrinsic value of price. If d1 is missing, then you can calculate the dividend of next year as whatever is the 0-year dividend plus the growth rate, so d0 into 1 plus g divided by k minus g. The formula is really easy, but the application has certain things that you all must know. First, what matters to you is the D1 as your first dividend. D0 doesn't matter. The formula start with D1. So this formula is doing what you should be able to understand. This formula does nothing but it discounts the D1 which are growing till infinity at a particular rate. So it discount all the cash flows from D1 till D infinity to 0 point. This is what this formula is doing. Able to interpret the formula or what this formula is doing for you is really important. Second, sir, cost of equity, we are clear with. Growth is really important. The growth matters to you is not the growth of the earnings of the company. What you are discounting are dividends. What you are discounting are dividends. So growth that matters to you is the growth of the dividends. But from which year to which year? Is it 0 to infinity growth, which should be constant? No. My first dividend is D1. So right from the dividend of first year till the dividend of infinite year, the growth that should be constant every year is what matters to me. The growth of 0 to 1 can be anything. So from 1 to infinity, the growth of dividend is what is to be used in the formula. Right? Now this is the beauty of outnotes that I want to tell you. The things which has a direct application in the practical question that we write. But there are other things or other point of observation about Gordon's model, which you need to understand, but not write them. You're not kids that you end up writing in every conclusion. So we summarize it. That please observe that the K will be always bigger than growth, right? Otherwise formula you cannot apply. Sir, the value used is D1. But the price arrived is at 0 point. The value used is D1, but the price arrived is at 0 point. An important note is here. Examiners say company is expected to pay the dividend, you call it D1. Company just paid the dividend, you call it D0. Company pays the dividend is a generic language. In case of confusion, we have observed that in 80 to 90% of the cases, institute has assumed the data to be D1. Whenever it is not clear, institute assumes it to be D1. Correct? Fine. Sir, growth that matters to me is right from D1 till D infinity, and the most important thing explaining now. In fact, you will learn later on why is it relevant to know that growth from D0 from D1 can be different, and what matters to me is only from D1 till D infinity. You will learn it later, and you will see its impact on your learning. Right now I want to bring it to you to the next discussion. Growth in your earnings and growth in your dividends, are they same, are they different, and when is that situation? Correct? So let's people in the class get it. At 0 point where we stand for this year ended, company's EPS was rupee 100. So company decided to distribute 50%, so company's DPS was 50. Basic. Earnings of the company grew by 10%. So EPS from 100 became 110. Company again thought of distributing 50%. So DPS became this time 55. If you observe the growth of your dividends, how much will it be? Sir, 50 and 55 gives you 10% growth. So did you observe the growth in your earnings was equal to the growth in your earnings also turned out to be the growth in your dividends. You know why? Because growth is between 2 points. Between 0 to 1 is the growth. Between 0 to 1 is the growth. And for those two particular points, if the payout ratio are constant or same, payout here is 50, here is 50. When the payouts of the 2 points are same people in the class, then growth between EPS and DPS for those 2 points, between those 2 points will be same as 10% or whatever. However, Let's say in the next year earnings again grow by 10%. From 110 it become 121. With 10% growth in earnings, let's say the payout, which was 50% at the end of year 1, turns out to be 60% at the end of year 2. In that case, dividend will be 121 multiplied by 60%, which is 72.6. If I calculate the growth rate, it is 72.6 minus 55 divided by 55. It turns out to be 32%. So did you observe something? That earnings growth is not turning out to be same as the dividend growth, obviously because at 0.50% of 100 was distributed, but that 10% growth in the earning happened, but this time I distributed 60%, leading to a bigger value of the dividend and getting me a higher rate of growth. In conclusion, growth is between 2 points, whether an EPS or DPS. If the payout ratio of those 2 points are not same, then growth in earnings will not automatically be same as growth of dividend, or maybe I can say the growth of dividend will not be same as the growth of earnings. That is the conclusion I want to draw. People in the class, how much out of 10 are you able to get? These are small minute conceptual clarities that will ultimately make your learnings really easy when you go to solve the practical questions. Come on, please, please, please. Sir, which has an implication? Implication that if the payout ratio of the company, for example, I stand at 0 point. This is me standing here. Examiner is asking me to predict the future dividends of the company because I have to discount them. Yes, sir. Then what? Sir, when it comes to predicting the future dividends of the company, if there is a change in payout, I cannot directly predict this particular dividend of second year. Can you predict directly? No, because I don't know this growth rate. If I have 50, I can add 10%. But if I have 55, what will you add? You don't know. So what is the way you will follow, everyone in the class? You will first of all calculate the earnings of the company of the future years. To those earnings, you will multiply the payout ratio so that you can find out the amount of dividend paid or distributed by the company as a percentage of EPS. That is the approach you will have to follow. Correct? So that is the conceptual clarity I wanted to deliver, and the practical application of these conceptual clarities you will 100% have when we go to the practical questions. Sir, now I have to tell you the growth of the earnings. This growth that you're talking about, which we have learned, do we have a formula to calculate this growth? I need the growth of the dividend, but I don't have a direct formula to calculate the growth of the dividends. But I do have the formula to calculate growth of the earnings, which is retention ratio of the company multiplied by ROE. It has a derivation here that we discuss in the batch, but not right now. But the logic is really simple. Retention ratio, the formula is really simple. Retention ratio into ROE gives me the growth rate. Do you remember retention ratio, that part of the earnings that we retain? For example, that 60% portion. ROE is the amount earned on the book equity, all financial statement based ratio, the rate of return of equity, that for example is 8%. So 60% multiplied by 8% is 4.8% is the rate of return or rate of growth of earnings. Please understand, this is not the formula that you directly use in the formula of Gordon's formula. This is not the growth you can directly use, no. This is the formula of growth of earnings. You observe then the payout ratio. If the payout ratio is same every year, then same growth of earnings can be assumed as the growth of dividend, and then you can solve the practical question. This is the clarity of concept that I want to deliver to you in this video right now. This is just a trailer of how it happens in the regular batches people in the class actually. Yes, so that was calculating the growth of earnings. Now, there is a possibility sometime institute may give you the data of past. For example, past few years dividends have been given. So you have to calculate the growth in the dividend on a compounded basis, which you can figure out from what you see here. Rarely there is a question which is question number 10 in the outscanner that we will see that belongs to this particular calculation. But I didn't want to skip it. I wanted that you all should just know that okay, there's something of this sort. If I have the present value 100, if I have the future value 130, can I calculate the growth rate? So 1 plus r to the power g, r to the power n automatically give me future value, right? So how much that growth rate should be, how much that r should be, that 100 when compounded using that rate for 4 years become 130. That rate you have to back calculate, which turns out to be a whatever number. On a lighter note, I wanted to cover this, right? Now I think I'll be able to take you to a lot of practical questions. So everyone in the class, let us proceed. Give me a minute, let me have water. Then we start our discussion with the practical questions. Right? Just give me a minute, let me have water. Perfect. Okay. Just a second, people. Perfect. So the first question that we're gonna do in the class is really simple, which is question number 2. Super ultra fast people in the class, let's try to process this question. Not that this question really deserves to be done in the class, but on a lighter note, let's discuss it. The company has book value per share of 137.8. We have been given the book value per share. It has a return on equity of 15%. Sir, when you see the ROE given to you, when you see the book value per share given to you, are you able to connect something? Yes, sir. There's a formula of ROE, which is a per share based formula, which is EPS divided by book value per share. So using ROE and book value per share, can you find out EPS? Yes. It follows the policy of retaining 60% of its earning. So if you have EPS, if you have retention ratio of 60%, can the payout ratio be 40%? Yes. Opportunity cost of capital, meaning to say cost of equity, meaning to say your discounting rate is 18%. We have to find out the share price today. Sir, let's figure it out one by one. I have been given the book value per share, I have been given the ROE. Then in that case, how much the EPS be? 137.8 multiplied by 15% give me 20.67 as my EPS. Of the EPS, 50%, 60 is retained, so multiplied by 40% is distributed, 8.268 is the distributed part, correct, which is dividend. Sir, then cost of capital. I actually need cost of equity. Either you can call it the ambiguity of the question that they don't specify the things clearly. Or maybe you can assume that total capital of the company does not have debt or preference, which means all it has is equity. So the total capital's cost is equity's cost, which is why cost of capital and equity will be same, making it 18%. Sir, if the growth has not been given, can we assume the growth to be a constant, the dividend to be a constant dividend model? No. Can the growth be calculated? Yes, sir. If I have ROE and if I have the retention ratio, then growth can be calculated of earnings at least, calling it to be a constant growth model. I'm trying to explain that in a simple question, what can be the level of thoughts you can have to get that needed clarity. Sir, 15 into 15 multiplied by 60% give me 9% of growth rate. But is that the growth of my earnings or dividend? This is the growth of earning. In the absence of information, we can assume the payout ratio to be constant every year, and that has been written down in the outnotes. You observe it. In the absence of information, dividend payout ratio is assumed to be constant, meaning to say I can say 9%, which is the growth of earning, will also be the growth of dividend. Now I have all the formulas. Sir, first of all, 8.268, what you have is assumed as D1. As I said, in the absence of information, assume D1. Minus KE of 0.8 minus growth of 0.09 of my dividend automatically gives me value. When you solve it, 91.87 is the answer of question number 2. Practically, it's an easy question, but when you apply some thoughts to bring clarity to it, it will bring the needed clarity. Question second gets done. Another easy question that we can do is question number 7. Please. Risk-free rate of return 9% RF given expected rate of return RM 13% given an expected growth rate of dividend is 7. Dividend last paid is 2. So D0 is given 1.07 of growth rate has been given. RM RF we have to talk about. Sir, beta has been given as 2. Beta has been given as 1.2. So 13 minus 7 into beta of 1.2 plus 7 gives me the required rate of return as 13.8, right? 13 minus 9, sorry, not 7. 13 minus 9, RF is 9. So RM minus RF into beta plus RF give me 13.8 as my required rate of return. So 0.138 minus 0.07 as the growth rate give me the value of share. The equilibrium price of the equity. Let's calculate it. 2 multiplied by 1.07 divided by 0.048 is 44.58. 1 second. 13 minus 7 is 0.68. Sorry. 2 plus 7% divided by 2 plus 7% divided by 0.068 is 31.47 as the equilibrium price or the fair price. Agreed, sir. Really basic, settled, taking you all ahead. Sir, what would be the equilibrium price? How the equilibrium price will change when inflation premium grow up by 2%, growth rate increases by 3%, beta become 1.3. When all these variables change, what will be the impact? When beta becoming 1.3, CAPM gets affected. In CAPM, we also have RF and RM. Let me tell you, all the rates around you, the actual rates around you are always nominal. And nominal have the effect of inflation included in it. They already include the inflation premium in them. Yes, which means when the inflation premium will increase by 2%, RM, RF, everything increases by 2%. Correct? All the rates increase by 2%, meaning to say revised RM will be 15, revised RF will be 11. So 11 plus 1.3 into 15 minus 11 multiplied by 1.3 plus 11 is 16.2 as the revised required rate of return. Fine, cool. Sir, growth rate become 3%. So 2 into growth rate increases by 3%, making it total of 7 plus 3, 10. So 2 into 1.1, D0 into 1 plus G divided by 0.162 minus 0.1. As you can see here, the equation of CAPM with the revised variables, the value of the share become 35.48. Only writing the value will not get you marks, You have to, people in the class, say They are asking how will the equilibrium price change. So at the end you will have to write down conclusion that the equilibrium price will change from 31.47 to 35.48. With this conclusion you will get the full marks. That is question number 7 gets done for you. Next question people in the class we would want to do is a great question, question number 11. People please look at this. Yes, who is this? I think I'll have to remove you for using the words which does not look good to everyone. Kesari. What a great question. Question number 11 is, and I will show you the presentation of this question in our handmade notes. So in our regular batch, right, where we have these handmade notes, we try to, present as many questions as possible on timeline. For example, if you observe here, this is the timeline. When the practical questions are presented in this manner on the timeline, it really makes the learnings very easy. So let me go to the start of the book where we have presented this particular question. Question 9th we are not doing. Question 11th has been presented. Wow. Let's read question 11 and then we figure out. Cool. This is the presentation. Let's read it. It says, in December 11, AV Company's share was sold for 146p0 has been given. Long-term earnings growth rate 7.5. Please observe growth has been given. But that has been for the earnings, not the dividend. AB is expected to pay 3.36 dividend. So D1 has been given, growth has been given, P0 has been given. What is the rate of return investor can expect? Investors expected, or in other words I can say required rate of return has been asked if dividends are expected to grow along with earnings at 7.5 years rate per annum in perpetuity. Till forever, the dividend will also grow with the earnings at the rate of 7.5. If that is the case, then how much is the required or expected rate of return? Sir, really simple. If they need expected or required, the first approach is CAPM, RF, RM, beta. But obviously that data is not given. But have we been given the data for the second approach, D1 divided by P0 plus G? Absolutely yes. D1 is 3.36, P0 is 146. 3.36 divided by 146 give me 0.023 plus 0.075 is 9.8 as the amount of KE, the number of KE. Sorted, easy, basic. Fine, cool. Taking y'all ahead. First part was really easy. The second part makes the thing more interesting. B part. It is expected that AB will earn 10% on book equity. On the book equity, the rate of return you earn is called as ROE. So they are saying AB has 10% ROE, shall retain 60% of the earning. So if ROE is there, retention rate is there, then the new growth rate will be there. So 10 multiplied by 60% give me 6% growth rate. The growth which is right now 6% of my earnings was previously 7.5, which means previously either ROE was different or maybe the retention ratio was different previously, which is now 10 and 60%. Do you agree? Sir, what do you assume to be different previously? Sir, actually ROE is something which you cannot change as easily as the retention ratio. So we assume the ROE to be more, constant over the years. So 10% was my ROE. Multiplied by there was some retention rate which gave me the growth of 7.5 previously. So the retention ratio must be 7.5 divided by 10 as 75%. Are you understanding? Retention rate was 75% previously, ROE was 10% previously. That retention rate has now changed from 75 to 60, whereas the ROE continue to remain the same. In this case, would there be any change in the growth rate and cost of equity? Obviously, the growth rate will change to 6%, and change in growth rate will affect the cost of equity. So basically, D1 divided by P0 plus the growth rate, it will change. So when the growth will change from 7.5 to 6, my cost of equity will automatically change. If you're thinking this much, then what you're thinking is incomplete. You're correct, but incomplete. So dividend will also change. The dividend which was previously growing at 7.5 will now grow at the rate of only 6%. This is the change. The dividend which was previously growing, this expected dividend of 3.36 of next year was based on the growth of 7.5, but now due to change in the policy, it will now grow at the rate of 6% if you agree. So D1 will also change, but it has one more layer of depth. The growth of 7.5 and 6 is not of the growth of dividend, it is the growth of the earnings. If you realize, your dividends change because of two reasons. First, growth of the earnings will change, and second, the payout will also change. Let me tell you. Right now, I estimated my existing D1, my existing estimate was 3.36. Do you agree? In the revised case, not just the growth is changing from 7.5 to 6, but the payout or the retention ratio is also changing, which is why also my dividend will change. So first of all, using dividend, I have to back calculate that what was my existing estimate of earnings of next year, calling it to be EPS1 or E1. 3.36 is the expected dividend existing. So what is the existing estimate of expected earning? Sir, it is based on 25% of payout ratio, maybe 75% of retention ratio that we back calculate using the assumption that ROE will be same as 10%. Sir, so 3.36 divided by 25% give me 13.44 as my earnings. Do you agree the growth belong to earnings, not the dividend? You cannot directly assume the dividend to be, growing at 7.5 and now regrow at 6%. No. You have to eliminate the growth of 7.5 and give the effect of growth of 6% to the earnings, not the dividend. So 13.44 divided by 1.075 and multiplied by 1.06 give me 13.44 divided by 1.075 multiplied by 1.06 give me 13.25 as the revised estimate of E1. 13.44 divided by 1.05 give me the present actual E0. This E0 as per my revised estimate will grow by 6%. 6% was the growth of earning. So E1 will be 13.25. That 13.25 people will now get 60% retention, means 40% distribution. So 13.25 multiplied by 40% is 5.3 as the revised amount of D1. What was the point of learning here? Sir, the point of learning here is, in conclusion, you cannot think that 3.36 is based on 7.5% growth. So let me divide it by 1.075 and multiplied by 1.06 and directly found D1. No. Dividend gets affected due to two reasons. First, change in the payout ratio and change in the growth of EPS, and that is the conceptual clarity I have already delivered to you. The growth in the dividend is affected by two reasons. First, how much is the earnings growth and how much is being paid out. Do you agree when there is a change in payout ratio from 50 to 60 or whatever, whenever there is a change in payout, people, you cannot assume the growth of earnings to be the growth of dividends, and that is the clarity with which you are solving the question in this revision video, that boss, it is the growth of my earnings. So from the dividend, first you have to back calculate earnings, give the effect of growth and revised growth to the earnings, and then give the effect of revised dividend payout ratio to it to find the estimate of revised estimate of D1 getting at 5.3. So now I will say 5.3 is the revised D1 divided by price of 146 plus 0.06 growth rate. 5.3 divided by 146 plus 0.06 growth rate is 9.63% of revised KE. That is this particular question. A small but a great question, question number 11. And as I said, the timeline presentation of questions make it really easy to process. Really easy to process. Yes? So that was only for your understanding. To the examiner, you never draw it. Bringing you to question number, just give me a second. The next question we're gonna solve is question number 13. I'm not going to entirely solve it, but just give you a sense or hint of it so that you understand it on a lighter note. Correct? Not the entire question I'm going to solve. Since it has been asked multiple times by the institute, this is the reason I'm solving it. Please look at this. What it says. It says company has debentures and bonds, company has equity share capital of 100 lakh, company has a reserve surplus, it has total assets of 6.6. The asset turnover ratio is 1.1, effective tax rate, interest rate, operating margin, etc. given. They are saying draw income statement. Using total asset and asset turnover ratio, can you calculate the revenue, total revenue of the company? Yes. What is the formula? Revenue divided by average asset is the asset turnover ratio. So 1.1 is the ratio, 600 is the average assets of the company, revenue becomes 660. From the revenue, if you deduct operating cost, you get operating margin, which is EBIT directly. From the EBIT, you deduct interest. So debenture and bond collectively become 175, on which the effective interest rate is 8%. So 175 multiplied by 8%. Give me the amount of interest deducted from EBIT, give me PBT. When you deduct tax, it give you PAT. From the PAT, when you deduct payout ratio, which means what percentage of PAT has been distributed, you get the retained earnings. The only income statement creation part is what I wanted to teach you primarily. The other things are you can do at your own. The main point of learning is learning the impact of effective interest rate, which means don't use the given interest rate, rather 175 into 8%. Second learning was using asset turnover ratio and total asset. You had to do the find out the revenue. Third was revenue into operating margin, directly give you EBITDA. Perfect. So that was question number 13. The next question we're gonna do belongs to the next category, for which we will have to first learn the next model. People, dividend discount model is the most comprehensive model that we have to actually learn. Are you people all ready to learn the next thing? Again, if you keep your imagination on the timeline, then you must say, then you would realize, then the questions of variable growth model are in fact more logical than the other questions. People, are you all ready? Shall we proceed? Yes. So just give me a minute, let me have water. Just give me a minute. Yes. So what was the situation of variable growth model? First of all, that should be clear. That, sir, when my dividends grow at a variable rate, not at a fixed rate. For example, we stand at 0 point where the dividend is 100 rupee. Examiners say for the next 5 years, dividend will grow like this: 10%, 15%, 9%, 8% for the first 4 years. Then 5th year and onwards, it will grow at the rate of 7%. A very strict recommendation is that whenever you see a question of variable growth, quickly draw a timeline in the rough part of your notebook. It may take additional 10 to 15 seconds, but you will never do a question wrong with the timeline. That is the approach that we have done in the class that you should also develop, or continue it if you are already my class students. Sir, on the timeline, I see that the growth from 0 to 1 is 10%, 1 to 2 is 15%, 2 to 3 is 9, and 3 to 4 is 8%. Then year 5 and onwards, tell me, growth of 5th year and onward year, it continue to remain 7%. So now I know that the basic rule remains the same. Present value is the future cash flow is the value of a share. So present value of future dividends I have to do, but can I apply Gordon's here? No. The condition for the Gordon is that you should have a constant growth rate. So do I have a constant growth rate every year? No. Not today, but at some point later on, I have a constant growth rate, right? My question to you all is, at the end of which year, if I stand and look at the future, I will have a constant growth rate forever. Sir, it is at the end of 4 year if you stand, you have a forever constant growth rate of 7% if you realize. If you stand at the end of 3, the growth rate is not constant. It is 8 and then 7. But if you stand at the end of 4th year, then you have a forever constant growth rate. Meaning to say, can I apply Gordon's formula here at the end of 4th year? Yes. When you apply Gordon's formula to calculate P0, you use D1 divided by K minus G. So if you have to calculate the value here at the end of 4th year, the terminal value, the value so arrived is called as terminal value, you will need the dividend of 5th year divided by K minus G. TV4 will be dividend of 5th year divided by K minus G. More important than applying the formula is the understanding of what is this formula doing to you. This formula of terminal value calculation is actually discounting all my dividends from 5 to infinity, and it is bringing them down to year 4. Right, so calculating at the end of year 4, the present value of dividend 5 to dividend infinity is all what terminal value 4 has. Correct. Now what? Since I have already discounted the dividends from 5 to infinity, which are lying at the end of 4th year in this value of TV4, now I need to just manually discount the first 4 years dividend: 0, 1, 2, 1, 2, 3 and 4. So along with the manual discounting of 4 dividends, and along with the if I discount the terminal value of 4 year and bring it to 0 point manually, simply multiply the present value factors to respective cash flow and calculate the intrinsic value at 0 point. This becomes the value of share. What was the point of learning? The learning was that ultimately I have to discount all the cash flow from 1 to infinity. We discounted it in parts. We identified a point where we can apply a terminal value, apply the Gordon's formula. We called it terminal value. So first part gets discounted here. In the second part, I discount the manual dividend and the terminal value to bring everything to 0 point. First thing. Second point of learning, since TV4 discount the dividend from 5 to infinity, we observe that 4th year's dividend is not discounted yet. Correct? Sir, this is why I was trying to explain you this conclusions related to Gordon's, that you use D1 to arrive at price of P0. This was the conclusion I maintained. So very similarly, you use D5 to discount, to calculate the price at the end of 4th year, which does not include 4th year dividend, which starts from 5th year's dividend. Which means 4th year's dividend is not discounted yet. It has to be manually discounted along with 1, 2 and 3. And that's how the terminal value and the 4 dividend give you intrinsic value. Right? Learning number 3. If you observe the table and if I ask you, tell me where should I calculate the intrinsic value? Maybe you will say at the end of 5th year. Because from 5th year, the growth rate is becoming constant. But when you draw the timeline, you realize, no sir, it is the 4th year where the growth rate is becoming constant, which is why I said create a timeline. This is first alternative. If you do solve it, for example, D0 is 100, add the growth, respective growth given in the question. So 100 plus 10% is 110, plus 15% is 126.5, plus 9% is 137. That way, if you do, right, you calculate the value, it turns out to be 2418. Very similarly, there is one more alternative using which you can solve it to get the same answer. Same answer. What is that alternative? Draw the same timeline. 100 rupee plus 10% plus 15% plus 9%. If I ask you at the end of which year, if I stand and look at the future, I will have a forever same growth rate, you will say fourth year end. Because then the growth rate is 7 everywhere. Let me tell you, you can calculate the terminal value at the end of fourth year, which you have already done. You can also calculate the terminal value actually at the end of third year also. What? At the end of third year, you can also calculate the terminal value and it will also be a correct solution. You know why? Because Gordon says when you calculate the terminal value at the end of third year, the first dividend we will discount is D4. And the growth rate which matters to us is from D4 to infinity, not from D3 to D4. If you calculate the Gordons at 0 point, the first dividend is D1. So growth rate that matters to me is from 1 to infinity, not 0 to 1. Very similarly, the growth rate for TV3 will matter to me is from 4 to infinity, not 3 to 4. That clarity of concept that I delivered to you, Gordons, is now getting applied here. And if you understand it, sir, I use D4 to calculate TV3. What does TV3 has? The present value of all my dividends from 4 to infinity. That TV3 has, which has not discounted the dividend of third. So dividend of 1, 2 and 3, I will manually discount along with terminal value 3, bring them to 0 point, calling it as intrinsic value 0. Even when you do this, you get the same answer except for the rounding of errors, which means you have two alternatives. The question is, which one is preferable? This one. This one is preferable, a normal case, alternative 1. But this alternative 2 of calculating terminal value 1 year prior to the point where I actually stand, the reason is when do you apply it is really simple. When we go to that practical question, I will tell you where do you apply the alternative 2, which is actually written down here. You won't have to worry about it of remembering everything. Cool. Sir, let's go to the questions, everyone. Question number 19th, let us solve first. Let's solve one question of both the alternatives and it will be sufficient to make the revision video really comprehensive. Yes, boss? So come on, let us proceed. An investor is considering to purchase the equity share of LX Limited whose current market price is 112. Share price has been given. The company is proposing a dividend of 4 or for the next year. D1 is being proposed for the next year. Let me open the timeline for you to make the presentation of this question really simple. You will like it, that I can just say. You are going to like it, that I can say. Question number 19. Dividend of next year is 4, as they say. LX is expected to grow 20% per annum for the next 4 years, which means first year, second year, third year, fourth year. For the next 4 year, dividend has been 20%, fine. The growth will decline linearly, so 16% per annum after the first 4 year. Listen to the interpretation of this line. Till the first 4 year, it is 20%. After 4 years, over some years, it will linearly decline to 16, which means from 20% per annum to 16% per annum, it will decline every year. How much will it decline? Will it decline by 1% every year or 2% every year? Linear means same decline every year. But how much has not been given? This is the ambiguity of this question. Fine. Thereafter, it will stabilize at 16. Over the year, it will decline to 16 and then it will become stable to 16. That is the growth rate. Forever, they are talking about required rate of return 20%, calculate intrinsic value. So ambiguity is we have not been given the information of decline. Let me teach you with this particular question. Whenever you feel the examiner has some ambiguity, the given data of present value factors, the given data of e to the power x given in the question, log natural value given in the question, right? Other values given in the question help you somewhere to solve the question. Let me assume 1% decline, which is the most natural case. Let me assume 1% decline. So first 4 year is 20% growth. Then let me assume fifth year 19, sixth year 18, seventh year 17, eighth year 16. And then it continued to remain 16, right? 1% decline every year. Please tell me at the end of which year, if I stand and look at the future, I will have a same constant growth rate forever. Sir, at the end of seventh year, as I can see, because then I have a 16% forever growth rate, which means should I calculate terminal value 7 here? Yes. What will that do? It will discount the difference from 8 to infinity and bring them to 7. Fine. Which means, do you agree? Then I will have to manually discount the cash flows from 1 to 7. Agreed. And the present value factor of 7 year has been given, which means my assumption of 1% decline every year was correct. And that's how the question to be solved. Right? Please on your calculators, take the number of 4, which is dividend of first year. 4 plus 20% is 4.8, plus 20% is 5.76, plus 20% is 6.912. Please observe on my calci it is 6.912. I am taking only 6.91 here, right? On my calci let 6.912 remain, then add 19% of it, it become 8.23 on the notebook. Calci is 8.22528, let it remain plus 18%. Means don't round off on the calci, round off only in the notebook, it become 9.71 plus 17% become something is 11.36. So I have the difference of the next 6 year. Cool. Next. Can I calculate the dividend of, I have the dividend of next 7 year. Now to calculate the terminal value of 7th year, I need the dividend of 8th year. How will my table look like? It's like 1, 2, 3, 4, 5, 6, 7 because of the dividend of 7 years. Because of the dividend of 7 year, I have the table rows till 7. And at the end of 7th year, I also have the terminal value. So 1, 2, 3, 4, 5, 6, 7 and 7 is the table format. For 7th year terminal value, I need the dividend of 8th year. Do you people agree? Dividend of 8th year will be really simple. Whatever was my dividend of 7th year, plus the growth rate of 16% in my dividend will give me the dividend of 8th year. D7 into 1 plus G automatically give me dividend of 8. Divided by K minus G, 20% is K, forever growth rate is 16%, automatically give me terminal value 11.36 plus 16%. Divide by 0.04 is 329.44. If I have all my cash flows with me, if I have the present value factors, discounting them will give you the value as 114, and we will say if the market price is 112, the share is undervalued, you must buy the share. People in the class, could I please really explain question number 19th to you all? Please tell me. Question number 19th, could I explain? The next question I'm going to explain is question number 21, where you will learn how do you apply alternative 2. But before that, I need this validation from every recorded student watching of this lecture. Please tell me. Please tell me. Or maybe you wait. When the 21st question gets over, you will have to comment down the level of understanding that you people have so far on the concepts and questions being done. Question 21, let us proceed, people. Perfect. Then you need to comment down and tell me how is your learning on this. Cool. So let us proceed. Give me a minute. Come on. Shoe manufacturing company or liquidity finance share capital 10 lakhs, not relevant. Face value 10, not relevant. I mean, not very relevant. The estimate of earnings are given below. The main thing I'm trying to read for you. The earnings and the dividend will grow at the rate of 25% for the next 2 years. Sir, we have been given the past earnings of the company right from 2010 to 2014. What it says, people in the class, the last earning was 9.6 and the last dividend was 3.84 for the year ended 2014. For the next 2 years, both of it will grow by 25%. Earning grow by 25 and dividend also grow by 25. Can I say if the earnings and dividend growth are same, then automatically the payout ratio of every year will be same for the next 2 years at least? So 0 year, if you calculate 3.84 was the payout, so divided by 9.6 give me 40%. Which means even in the first and second year, it will continue to remain 40 because then only the growth of earnings and dividend can be same at 25. Cool. Earnings are likely to grow at the rate of 10% from third year and onwards. From third year and onwards, meaning to say for third year and onwards, it will grow at the rate of 10% because first two was 25, then the growth rate will decline to 10. Cool. Can you all first of all feel a variable growth model, everyone in the class? Where growth in the initial years is different and then for a later year forever it is different. Fine. Further, there is a reduction in the earnings growth, dividend payout ratio will increase to 50%. Sir, till second year end it was all fine. But as the growth declines from 25 to 10, the payout ratio will increase to 50% and then every year it will continue to remain 50. Can you all please feel that the payout ratio of the future year is changing? Initially it was 40, then later on it turned out to be 50. Please open your out notes and observe that whenever payout is changing in the future year, the earnings growth cannot be assumed to be dividend growth as it is. Can you feel how is this question turning out to be different from previous one? That growth in the earnings cannot be as it is assumed as the growth of dividends and cannot be simply solved. This clarity I wanted to deliver. And if you realize, let me now tell you, if there is a situation where growth of the future payout is changing, if the dividend payout ratio of the future year is changing, you will have to apply alternative 2. So first of all, tell me what matters to me. Is the growth of earnings or dividend for valuation? Sir, growth of dividend. I have the growth of earning, using which can you calculate the growth of dividend? Yes, sir. Sir, how would you calculate? Sir, I have to actually find out the amount of dividend by way of earnings. Meaning to say, first 2 years is fine. But after that, how much is the growth? Can you calculate? No, I have to find out earnings. And to the earnings, I have to multiply the payout ratio to find out the amount of dividend. So learning number one, what matters to me is the growth of dividend, not the growth of EPS. Learning number two, since the payout is changing, I cannot directly find out the growth of dividend. Learning number three, then how do I find out the amount of dividends? How do I find out the amount of dividends, people? That you find out using the earnings and its payout, which is why if you observe the presentation, if it's the question, we will not have the cash flow column directly after years. We will also have the column of EPS, we will also have the column of payout and then calculate the cash flow, which is dividend per share. Sir, then next question is which alternative will you apply? Alternative 2. Next question is where will you calculate terminal value? Do you people observe that at the end of, so this is at the end of third year, which means 15, 16 and 17. At the end of 17, if you observe, payout is 50 and after that every year payout is again 50, which means from this point the earnings and dividend growth will be same. So can I say at the end of third year, which is 2017, if I stand, my growth of dividends I'm saying will be constant forever? Agreed. Which means if I apply alternative 2, I can calculate terminal value 3. But since payout ratio is changing, I will have to apply alternative 2 and I can calculate the terminal value even at the end of second year, which is 2016 if you observe. Yes. Sir, for calculating terminal value of 2016, I will need the dividend of 2017 if you realize. So dividend of 2017 till the dividend of infinite year, all those will be discounted to terminal value 2. Which means I will have to manually discount only the dividend of first year, only the dividend of second year and only terminal value 2. What do I need? How will my table look like? It will be 1, 2 and 2. Dividend of first, dividend of second and terminal value of second. Only thing is that to calculate terminal value 2, I will need dividend 3, which is 2017. And this dividend 3 cannot be directly calculated. It can be calculated only by way of earnings into payout ratio, which is why my table will look like as 1 to 2. 2015, 16 and 16. EPS then payout then dividend. EPS will be 12. For example, 9.6 plus 25%, 9.6 plus 25% is 12 plus 25% is 15. Fine, sir. Into 40% payout ratio, give me the amount of cash flows, dividends. Fine. Now terminal value of second year will be dividend of third year, and dividend of 3 can be calculated using earnings of 3. So 15 was the earning of second, plus 10% will give me the earnings of third. 15 plus 10% is 16.5 earnings of third year, which will have 50% payout ratio, then increased payout ratio of 15. So please observe, 15 plus 10% is 16.5 multiplied by 50% give me 8.25 as the dividend of third year, which will be used for terminal value 2, divided by KE of 15 minus discounting rate 15 has been given below here in the question, divided minus the growth rate of 10% forever. Yes, that forever growth rate you will use. In the formula, the G that you use is the forever growth rate. The growth from D2 to D3 will not matter for TV2. Growth from D3 to forever will matter, which is 10%. So divided by K minus G. So 15 into 1.1 multiplied by 50% divided by 0.05 give me 165 as the terminal value of second year. Dividend of second, terminal value of second, and the discounting factor give me the total value, which people in the class solves question number 21. A great question to really learn a lot of things. What have you learned? To compile for you. Learning number 1, earnings growth will not matter, dividends growth matter. But the payout is changing, you have to apply alternative 2. And since payout is changing, dividend growth is different from earnings. When you apply alternative 2, you have to go by way of earnings and then apply payout ratio to calculate the final dividend value. And that is how you give the effect of it in the table. People, that was question number 21. Now you will have to particularly comment down and tell me, could I explain those alternatives and the applications of those minute things that you learned in the Gordon's model to the practical questions, boss, in question number 21 and also in the previous question. Yes, public? 21 gets done. The next question that we should solve, I am not going to entirely solve it, but only guide you for that, is question number 25. People in the class. Question number 25. Not going to entirely solve it for you, only guide it. Directly explaining the question number 25. Give me a minute. Question 25 says, I just paid dividend of 2, which will grow at the rate of 6% forever, and the required rate of return cost of equity capital firm is 8%. What is the value of share? So it is like 2 plus 6% divided by 0.02, give me 106 as the share price. Now they say, after we paid this dividend, we thought of investing, we thought of making more investment. More investment in a capital project require more money. So we decided that we will retain the next 3 annual dividend. We will not pay dividend. Earn it and invest, not distribute. We will distribute the dividend at the end of 4th year, where amount of dividend will be 2.5, which will grow at the rate of 7%. With this mindset, how will the timeline look? Earnings of every year you will have. But for the next 3 years, you will not have dividend. Your first dividend will be at the end of 4th year, having 2.5 rupee value, which will grow at the rate of 7% forever. First of all, which model it is? Gordon's model or variable growth model? So dividends, if you observe, initial year growth is 0. Then suddenly there is a growth, and then later on 7% growth is there forever, which means variable growth model. Alternative 1 or 2. Sir, payout ratio is changing, examiner did not say, but you can observe there is some earnings. you did not distribute is a zero payout ratio. Later on, you started to distribute, payout ratio is changing, means you will have to apply alternative 2, which means at the end of which year, if you stand and look at the future, when do you have a constant growth rate forever? Sir, fourth year. See, 2.5 dividend growing at the rate of 7% every year. But if you observe people, alternative to make you calculate the terminal value a year back, a year backward to that. So I will have to calculate terminal value at the end of year 3. TV3 will be actually D4 divided by K minus G, which will discount all the cash flows from D4 to infinity, right? Which is there in TV3. So I have to manually discount dividend of 1 to 3 and the terminal value 3. Since the dividend of 1 to 3 are anyway 0, all I have to discount is the terminal value 3. So if I discount terminal value 3 using the present value factor of 8% for 3 years, sir, the final answer turns out to be 198.5. Objective was not to solve it, but only to explain it. D4 is 2.5 divided by K minus G. Growth is 7 now. K remains same, giving me a terminal value. When discounted, gives me 198.5 as the price. Are you observing the timeline makes the question, even the complicated question, more imaginable and really easy to solve? That was people in the class question number 25 if you observe. Boss, do you see it? So that gets done. Broadly, this is what I had to explain, right? Rest of it you will have to do at your own. Sir, the next thing you have to learn is the next model, which is cash flow based discounting model. Cash flow based discounting model. The dividend discounting model gets done. The cash flow based discounting model also more or less have the same thought process. In the dividend discounting model, we also have H model, not discussing in this video. Reason is really simple, because institute people in the class has never asked a practical question on this. However, if you want to look at the formula, this was the formula that we had done in the class, right? Cash flow based valuation model. Rather than considering the dividend distributed by the company to the shareholder, which was a cash flow actually received by the shareholder, we will in this case do the cash flows earned by the company, which is available for distribution to the shareholder or to the capital provider. The thought process is calculating the free cash flow to the firm or the free cash flow to the equity, and using these cash flows to arrive at the value of the company. The underlying thought process, do you remember? The free cash flow to the firm means the cash flow which belongs to the entire firm, which means the cash flow which belongs to the equity and debt and preference, meaning to say all the capital providers. The cash flow which belongs to all of them is the cash flow that belongs to the firm. Then there is a cash flow which belongs only to equity, not even to debt and preference, that is FCFE. The way to calculate the cash flow was really easy. Whenever a company does business, it generates profit, but that is not cash flow. Profit is an accrual number. From that, you make adjustment of certain things to find out the available cash flow, and the thought process is the same as you have learnt in the cash flow statement preparation. So if I have the PAT with me, do I not add back depreciation to it? Do I not consider the change, increase or decrease in the working capital to arrive at the cash flows that you've done in the cash flow statement? Yes. Sir, when it comes to the FCFF of the firm, free cash flow of the firm, you start with the profit, but the profit which belongs to all of them, not only to equity. Can I say EBIT, sir, is that profit which belongs to all of them? To the equity, to the debt, to the preference shareholder? Yes. Calling it operating profit. From this operating profit, when you deduct tax, when you multiply 1 minus 2 to it, we call it net operating profit after tax. So it is called as NOPAT. NOPAT is EBIT into 1 minus T. So to the EBIT, when you multiply 1 minus T, you get after tax operating profit. You add back depreciation because it was non-cash and was deducted in EBIT. You deduct working capital change, that also helps you to calculate the cash flow. And next thing you do is really important. That is new to learn beyond the cash flow statement that you've learned in FR. Sir, what is the next thing? When a company does business, it generates cash. So, for example, we have calculated cash flow from operating activities. On a lighter note, please accept it. Because we added depreciation, we deducted working capital change, we have CFO. That cash which the company has available in the name of CFO, can the company distribute this cash to these people? Ultimately, they have the claim over the cash flows of the company. It is agreed because they have given money to do the business to the company. But before distributing to them, company might be needed to first purchase some fixed assets so that it can grow, so that it can do a bigger business, so that it can maintain its business. Yes. So this available cash flow, from this available cash flow, company first make the capital expenditure, purchase some fixed assets, and after that whatever cash is left, then company pass on to them as a whole, saying that this is the cash flow distributable to all of you. On this cash flow, all of you have that claim, calling it to be the FCFF. Starting with the profit that belongs to everyone, but that is accrual. Adding depreciation and deducting working capital from it to convert it to the cash profit, deducting capex from it to convert it to the free cash flow to the firm. Similar logic for FCFE. You start with the profit that belongs only to equity, calling it to be the PAT, the final profit, from which interest and everything has been deducted. Then you add back depreciation, deduct working capital to find out the CFO. Do the adjustment of capex. Capex is also deducted to find out the cash flow which is available to them. But do you agree? We want to find out the cash flow available only to equity. So deduct or adjust the inflows and outflow related to debt and preference to get the final cash flow payable only to equity. To the debt, you pay interest. Do you agree? While calculating PAT, the interest is already deducted. Yes, sir. To the debt, you also repay the borrowing. So if there is any borrowing, if there is any repayment of borrowing, you need to deduct cash that goes out before going to equity. If there is a borrowing, that is an inflow you have, that you add before final amount reaching to equity. So repayments are deducted, outflow for the company, borrowings are added, inflow for the company. Similarly, to the preference shareholder, if you are paying something in the form of preference dividend, then that is also being deducted, right? And the net number is what you say is the cash flow which is available only to equity. Sir, similarly, if there is any redemption of preference share, that should be deducted. Issuing the preference share is an inflow that should be added, agreed. But examiner never asked that, which is why I did not write it. But logically, what you're thinking is correct. Doing all these adjustment, first converting the PAT to CFO, then deducting the capex to make the cash flow available for all of them, then making the adjustment of cash flow related to debt preference will give me FCFE. That is what we have done. PAT to CFO, adjusting capex, and then adjusting the cash flow related to other capital provider, get you FCFE. The underlying logic of this valuation model is also same. Present value of future cash flows is the value of share. The future cash flow include the FCFE and FCFF. The present value of all these future cash flow give me the value of share. If I follow this model, the present value of all FCFF will give me the value of the entire firm. Meaning to say, if the cash flow belong to all the capital provider, the discounted value so arrived should also belongs to all the provider, calling it to be the value of firm. Similarly, if FCFE is discounted, if the cash flows of the future year belong to only equity, the discounted value of those FCFE should also belong to only equity, calling it to be the value of equity. One more thing, FCFF is the cash flow that belong to everyone. So discounting rate should be the required rate of return of everyone. Weighted average cost of capital, KO WACC. If the cash flow belong only to equity, so the discounting rate should be the required rate of return of only equity, calling it to be the cost of equity, already learned there. So WACC is really simple: cost of equity, weight of equity; cost of debt, weight of debt; cost of preference share, weight of preference share, right? You can consider it without me writing it. Sir, the weights are really important. If the examiner has a target capital structure, for example, 20% should be equity, 40% should be debt, rest of the 40 should be preference share, that original target weights should be followed. If they are missing, consider the market values given in the question to be weights. If they are also missing, consider the book values given in the question as your weights. So these are the weights to be considered for KE, KD, everything. This will give you WACC, and FCFF when discounted using WACC give me value of the firm. Similarly, FCFE when discounted using KE give you the value of equity. So imagine the sequence of the question. First focus on calculating this. If that is ready, focus on calculating this. If this is also ready, then focus on calculating the value of the firm of the equity, which means discount FCFF using KO or FCFE using KE. There are three ways to discount which you have already learned: zero growth, constant growth, variable growth. No growth in FCFF or FCFE, simply FCFF1 or FCFF1 or FCFE1 divided by K or KE respectively give you the value of the firm or equity. If there is a constant growth, FCFF1 divided by KO minus G or FCFE1 divided by KE minus G give you the value of the firm. Or if the growth is variable, then you identify a point to calculate terminal value. There is only alternative one here. You identify the point from which the growth looks constant forever. That particular point is the terminal value point. So present value of terminal value and present value of all the FCFE and FCFFs till that terminal value calculation give you the value of the firm or equity. So discounted at the rate of KO and KE is the variable growth model which we gonna solve in the class. Sir, once you have the value of the firm, deducting value of debt or maybe deducting the preference value share, value of preference share from the value of the firm give you value of equity. Similarly, if you have the value of the equity calculated, adding the value of debt or adding the value of preference share, the market values obviously give you the value of firm. Which means using both the approaches you can calculate both the values, correct? Which exact approach to follow depends on the data given. If KO given, right, if the KE is given and KD also given, it is a hint that KO calculation should happen. When PAT is given, then it is a hint that FCFA to be followed. When EBIT is given, it is a hint that FCFF to be followed. Depending upon the data given, we have to identify what do we have to do. We're gonna solve 3 to 4 practical questions of this category to make the learnings really comprehensive. But I would suggest you to first take a 2-minute break. Let's take a 2-minute break, then solve all the practical question at a stretch and then move to further practical questions. We'll study for at least 3 to 3.5 hours at a stretch, then take a 20-minute break, then continue with the other things. Yes, so let's take a 2-minute break first. 11:10 it is. Let's meet back at 11:12. Okay, see you all after 2 minutes. Have water, settle down, use washroom, come back, then let's continue. Are you all there? Just give me a second. Let me wear the mic. Cool. So people, let's solve the very interesting practical question of this category. So I think the first question that we should solve, I got it, is the first question from the attempt of September 25, right? So in your outscanner, this question will either be in the initial pages, right? Or this question will be in the section of free cash flow based valuation. So either be in the initial pages. So in the initial pages, we have this question which was asked in the September 25 exam, or this question will be here. Where would this question be? In the chapter of equity business valuation, after the dividend valuation gets over, we have the cash flow based valuation that starts. In the cash flow based valuation questions, it will either be somewhere before this question, okay, this is what my guess is, because see, right now it's in the initial pages, but maybe you refer this video after 2 years. Now after 2 years, when the outscanner gets updated, this question is somewhere inserted here, most probably. Okay, so let's see how it happens. It will be somewhere after this question in your outscanner. In my outscanner right now, it is in the initial pages. Let me explain to you question number 4, an easy question asked by the institute. Cool. So ABC Limited share currently traded at a price of 192.5. Fine. Ronnie is planning to purchase the share of the company. For this purpose, he has taken the service of the financial analyst. The financial analyst has given the below information. What information has been given? Before tax, required rate of return of the company for debt, preference and common equity is 8.6, 11 and 13% respectively. We said okay. Company's target capital structure is 20, 30 and 50%. Respective KE, cost of preference, and KD, cost of preference has been given, and weights in the target capital structure has been given. Fine. Market value of company's debt is 275 and that of preference share is 120 million. Cool. There was a mistyping, so I've added it manually. Fine. Free cash flow to the firm, sir, FCFF is 125 million has been given. FCFF given. Cost of capital, WACC calculation inputs have been given. Expected growth rate 8% given. Tax rate 30% given. And 20 million shares given. Cool. On the basis of value per share, advise whether should we purchase the share of the company or not. Sir, FCFF and WACC help me calculate value of the firm. Using that, how do I calculate the value of share? Sir, from value of firm, if you deduct value of debt and value of preference, you will get the value of equity. To that value of equity, when you divide by number of share, you get per share value of equity, which will be the intrinsic value. The actual price in the market is 192.5. Comment on the actual to figure out if that is overvalued or undervalued. This is the question. Really a good question and a basic one asked by the institute in September 25 exam. What it says? It says, sir, first of all, let us find out the individual cost and then calculate WACC. I have been given the before tax required rate of return. But do you agree? For debt, there is a tax benefit. So how much is after tax required rate of return for me? 8.6 multiplied by 1 minus 30, which is 70%. But for cost of preference and cost of equity, there is no tax benefit. So how much is overall KD? 8.6 into 70% is cost of debt, which has 20% weight. So into 20% M plus. Then 11 multiplied by 30% M plus. 11 multiplied by 30% M plus. Then 13 multiplied by 50% M plus. Memory recollect is 11.004. Calculating it to T2 digits after the decimal point give me 11% as my WACC. Fine, sir. Sorted. FCFF is there. WACC is there, growth is there. What about calculating the value of the firm? Sir, 125 is the FCFF of year just ended. FCFF 0 has been given. Sir, what if this information is not given? Will you assume FCFF 1 similar to D1? No. Dividend was always assumed for 1 year. FCFF, FCFE is assumed always for 0 year if the question is silent. Cool. Sir, 125 FCFF 0 into 1.08 growth rate divided by 11 minus, which means 0.11 minus 0.08, right? So let's calculate 125 plus 8% divided by 0.03, giving me 4500 as the value of the firm. From 4500, if you deduct the value of debt and preference, which means minus 275 minus 120, give me 4105 as the total value of equity. Divided by 20 million share, give me 205.25 value per share. If the actual price is 192, fair is this, we will say we should purchase the share. They are underpriced in the market. A logical and an easy question. Cool. Next part. Assume we get the same value of equity as calculated in part 1 using FCFE approach. This 4105, the value of equity which you have got. Suppose you get the same value of equity as part 1, but this time if you use FCFE approach, calculate the free cash flow to equity if the growth rate is 8.85. What will FCFE 0 will be? FCFE 0 for the just year ended FCFE 0 will be if the growth rate of 8.5% is taken, cost of equity of 13% is taken. Needless to mention, if it is FCFE, you will have to take cost of equity minus the growth rate of 0.085. To get the same value, how much should FCFE 0 be? If the growth changed to 8.5 and cost of equity is 13 is the revised question they are asking. Sir, 0.13 minus 0.085 when you multiply to 4105 and when you divide that with 1.085 give me 170.25 million. Since the data of million has been given, we will do all the calculation in terms of million, that total 2 digits after decimal points. So 170.25 on my calculator is 170.2534, but I'll take it as 170.25. That's a great question, question number 4, which gets done. Cool. The next question I'm going to take is the question from equity business valuation chapter, right? I mean, in that chapter itself, this was also the same chapter, but it was placed somewhere else in the outnotes. Now, taking you all to this chapter, please look at the question. Go to the section of equity business valuation in your notes. Perfect. This is the section. The question we're gonna do right now is this particular question that you see here. Mr. Amit question. Please note that when you watch this video, maybe 1 or 2 years after this, there's a possibility that 1 or 2 question up and down may happen. In your book, this may be question 36 or maybe 32, I'm not sure. Cool. So let's solve this question. Mr. Amit is happy with the investment paying good dividend. Last year it paid a dividend of 2, currently trading at 150 share. Dividend discount model, the value is undervalued. This is what Amit is claiming, right? Financial expert has, as a financial expert, examine his view that dividend discount model represents fair value. Cool, fine. After that, it says on the basis of following information, also calculate the value at your own. What is the information given? Profit after tax given, equity capital of the company 1300 given, par value per share face value 40 given, debt ratio, which means debt divided by debt plus equity. It is not debt divided by equity. Debt divided by debt plus equity in the denominator, which means out of my total capital, the component of debt is 27%. Long-term growth rate 8%, beta 0.1, RF 8.5, RM 10.3, capex, depreciation and working capital change per share is this. First of all, based on the data given, which method of valuation will you apply? Obviously, free cash flow. Because depreciation, capex and working capital comes only there. Now, whether FCFE or FCFF, what will you apply? Between the two, what will you apply? Sir, if PAT has been given, if the information for KE has been given, beta, RF, RM, will you apply FCFE approach? Yes. For FCFE approach, you need FCFE, you need KE, and you need the value of equity. Three things you have to do. In FCFE approach, which model? Constant growth or variable growth? Because growth rate has been given and only one number has been given, I will apply Gordon's model, constant growth model. So let's first of all calculate FCFE. Starting with the PAT of the company, do you agree that if all other numbers on a per share basis are given? So let me also calculate PAT on a per share basis. Depreciation is per share, capex is per share, working capital is per share. So PAT per share will be 2900 of total profit divided by number of share. Equity capital 1300 divided by face value per share of 40 give me 32.5 as my number of share. 290 crore divided by 32 give me per share earning as 290 divided by 32.5. How many on the number of share? 32.5. Give me 8.92. I have to take it till 2 digits after the decimal point. So 8.92 as my EPS. To the PAT per share become EPS. I add back depreciation. So 39 I add back. I deduct working capital 3.45. I deduct capex. So 8.92 plus 39 minus 47 and 3.45 is what I have done. This looks logical. This question has a particular hidden adjustment which is actually a point of learning to you. Please pay attention to this. Sir, imagine the balance sheet of the company. Do you agree that depreciation is a non-cash expense? Which means while calculating profit in the income statement, depreciation gets deducted. So EPS is a profit is a lower number which when gets distributed to the shareholder, the profit goes out but the entire cash does not go out because depreciation is available with the company in the form of cash because it was non-cash, the cash did not go out of the company. Agreed? I'm not going into the in-depth logic of it, but on a broader note, intuitively I want to explain. Depreciation was a non-cash. Profit gets deducted, which is why dividend when it gets distributed to the shareholder, the dividend when goes out, the entire cash does not go out of the company because of the amount of depreciation, cash remains in the company. Right? Sir, the cash is there with the company. How much cash remains with the company? Equal to the amount of depreciation of 39. Now you say that in this year you want to make the investment of 47 and 3.45 in the capex and working capital. So total 47 plus 3.45 give me 50.45 as the total amount of investment I need to make. How much? 50.45. Out of 50.45, 39 is the cash available in the asset side of the company. So 11.45 is the additional capital I will need to make the total investment of 50.45. So from my capital provider, equity and debt, I need 11.45. Can you take it from equity entirely or debt entirely? No, there's a debt ratio of 27%. Of whatever capital you need, 27% should come from debt. So 11.45 is that number multiplied by 11.45 multiplied by 27% is 3.09. The amount you need to take from debt, you need to borrow. Is the hidden adjustment you will have to kind of remember even if it is logical. Examiner nowhere specified there is a borrowing, but this ratio give you automatically the hint that whatever additional capital you need, you get 27% of it from debt is 3.09 borrowing inflow. So 8.92 inflow, depreciation you add inflow, the other two are outflow, so borrowing is inflow and the final answer is 0.56 which is assumed D0. KE calculation is easy. So FCFE 0 into 8% growth rate divided by K minus G give you the value of share as 70.33 as this particular question had point of learning. Perfect. Sir, value of share is done. Second part of the question is actually theory that as per dividend valuation model there would be some value, fine, right? So you calculate the value of share as per dividend valuation model. FCFE model give you 70.33 value. Dividend valuation model give you this value where the market price is 150. Right? Will you say the share is undervalued because CMP is lower than dividend valuation model? Or that is what they are saying? We say that's not correct. Because in theory, I'm not reading that but just explaining to you the paragraph written here. In conclusion, it will say the cash flow based valuation model is more reliable. Dividend policy of the company can be changed. Changing the fair value of the company is not that reliable. This method is not reliable, which is why cash flow based valuation model is more reliable because you cannot change the cash flow. What you actually earn is earn. You can never change it at your own. 34th question, people in the class gets done. The theory has been explained. Next question we're going to solve is 35th question. People, ultra fast question number 35th. Question from variable growth model we do. The previous two questions were constant growth model, now is variable growth model. Directly reading the question for you. Sir, company is expected to grow 20% for the next 3 years, after which it will grow 8% perpetuity. Variable growth, next 3 year different growth, then after 3 years forever same growth. Revenue, COGS, other operating expense, capex, depreciation has been given, which is already included in operating expense. Different number for the year which has just ended has been given. Cool. Now, please observe, operating expense means all my operating expense including COGS. But if you observe, COGS is 3 and operating is 20 to 50. It obviously implies that the operating expense does not include COGS. These are the expenses operating in nature other than COGS. So the total operating expense actually become 3 plus 2250 as 5250. Yes, anyways. During the high growth period, revenue earnings, this is an interesting question. Let me tell you, I will simplify it for you to make sure you learn every single aspect of this question. All you have to do is to pay attention, right? And obviously like the video if you have not done it so far. Cool. Sir, revenue and earnings of the company will grow 20%, right, during high growth period, which means for the next 3 years. Cool. And capex depreciation will grow at the rate of 15% per annum during the next 3 years. From 4 year onward, revenue and EBIT will grow at the rate of 8%. Capex will be offset by depreciation. Sir, let me explain to you this particular line and this particular line. While calculating FCFF or calculating FCFE, do you add the depreciation? Yeah. Do you deduct capex? Yes. So the net capex, the capex net of depreciation, the capex capital expenditure net of depreciation will grow by 150%. If capex was 750, depreciation was 600, net was 150. This net everyone in the class will grow by 15% in the first 3 years is what they are saying. Similarly, from 4th year onwards, capex will be offset by depreciation. You add depreciation, deduct capex. The two numbers will be same and they will be offset by each other. That is what they are saying. During both high and normal growth period, net working capital requirement will be 25% of the revenue. Cool. WACC 15%, tax rate 30%, using FCFF and WACC methodology, calculate the value of the company. Take your time. Just take 20 seconds to read the entire question once, then I will explain to you the plan. Come on. Super ultra fast people, next 20-30 seconds to read the question, then I will explain to you. I would say, let us decode the entire question. I need to apply FCFF model. What do I need for FCFF model to find the value of the firm? I need FCFF, I need KO. One second, sorry. So just for information, since this file has coincidentally opened, let me tell you, on the YouTube, every attempt I come up with this file called as new question by ICI, which has the solution of all new questions added by the institute in the last 5 attempts, RTPs, MTPs exam paper. That PDF is released every year, right, every attempt. Also, for the latest attempts, MTP, RTP and exam paper, we do solve the practical question in a video, write all those new questions. So the video is also there. The link to that I will share in the description. That too is also there in full English as well as full Hindi. And again, uh, the file is also there. Cool. Since that file fortunately opened, I thought of sharing that with you. Back to it. I need FCFF, I need KO, I need G. Do I have the KO with me? Yes, sir, already given. I need FCFF. Sir, FCFF of how many years you need? Is it the 1 year or multiple year, depending upon the type of model? Since it is a variable growth model, I have to first of all figure out that at the end of which year I will calculate terminal value. Accordingly, I'll be able to figure out for how many years FCFF do I need. I'm trying to teach you right from the scratch how should you think for a question. Else I could have started doing it directly. Sir, do you agree for the next 3 years, same growth? 1, 2, 3 years, same growth. From 4th year onwards, 8% growth. So do you agree at the end of 3rd year, if I stand and look at the future, I will have a constant growth rate forever? Yes. So I should calculate terminal value 3. To calculate terminal value 3, I would need FCFF4. So basically, I need FCFF 1, 2 and 3 to manually discount it. I need FCFF 4 to calculate terminal value 3. So in total, I need the FCFF of 4 years. For FCFF, I need EBIT of 4 years. I need depreciation of 4 year. I need capex of 4 year. And I need working capital of 4 year. EBIT of 0 year, if I have, I know it will grow by 20%. Next 3 year and 8% from 4 year. EBIT is sorted. Depreciation and working capital is sorted. We have already seen it. 15% net number for the next 3 years. 4th year it will offset. Then I need the working capital for next 4 years. So first of all, the imagination of the question on the timeline gives you an understanding that for how many years do you need to do the calculation. So let's first of all create the working capital working note for 4 years. 0 year, my revenue was 7500. 25% of it was the working capital requirement. 7500 into 25% is 1875. Revenue for 3 years will grow by 20% and then it will grow by 8%. So 7500 plus 20% is 9000 plus 20% is 10800 plus 20% is 12960 plus 8% is 13996.8. 25% of respective revenue amount is the working capital. I don't need the total working capital for FCFF calculation. Please observe the outnotes. Do I need the total working capital or I need the change in the working capital? I need only the change. If you observe, sir, please look at this. 1875 is the working capital at 0 point. At the end of first year, it will become 2250. So how much is the change that happened in the first year? Sir, it is 2250 minus 1875 giving me 375. That way I calculated the change for the next 4 years with this working note. How much is the EBIT of 0 year? 7500 minus all the operating expenses. 7500 minus 3000 minus 2250 give me 2250 EBIT of 0 year. Let's increase the EBIT by 20% for the next 3 years, then by 8%. Plus 20% is 270 plus 2020 is this. So 3888 plus 8% is 4199.04. EBIT into 1 minus T all directly give me NOPAT. So let's assume the number of NOPAT is ready with me. Minus working capital change, respective working capital change through the working note I have calculated minus the capex net of depreciation. At 0 point net number was 150. Let me increase it by 50%. So 150 plus 15% is 172.5 plus 15% is 198.35 plus 15% is 228.13. Last year it is 0 because first is compensated by the another. Perfect. So if I have the NOPAT, working capital, depreciation, capex of all 4 years ready with me, can I have the FCFF ready with me? Yes. The first 3 year FCFF I need for the purpose of discounting directly. 4th year FCFF I need to calculate the terminal value of 3 years. So table is 1, 2, 3, 3. 3 cash flows and 3rd terminal value. The 3 FCFF. 4th FCFF divided by KO minus G give me the terminal value. So 2680.13 divided by KO is 15, forever growth is 8. So divided by 0.07 is 38287.57. 14 if you want to take it till 4. Give you the terminal value. 3 FCFF and third terminal value when discounted with the rate of KO give you the total value of the firm, which is 28871.01 crores as the answer to this question, particularly 35. So whenever variable growth model is there in your mind, first of all, you will have to imagine where will the terminal value be. Please observe, we are not only solving the practical questions in this video, but trying to fit the practical question to the concept, trying to learn the process or the underlying, background of the practical question. Sir, whenever you have a practical question, observe if it is a variable growth model. If it is, find out for how many, find out where will you calculate terminal value, and accordingly you will get to know for how many years you need those FCFE, FCFFs. The working notes will be for those many number of years, and accordingly the FCFF, FCFE will be for those many number of years, and accordingly the table will be there. Perfect. Question 35th, I hope I could explain with complete clarity. The next question that you're gonna do is just give me a second. Question number 38. The objective is not to fully solve the question, but on a lighter note, give you a context of it, right? Some question we fully read, fully solve, but some questions we do only for the sake of understanding, right? Rona, can you please put this doubt on the Telegram group actually? Right now it will, distract me for recording this. Is it possible, please? Sir, question 38. Let me show that question on the timeline to you, and then you will realize how easy the question becomes. Question 38. Very well presented on the timeline. People in the class, please pay attention what is happening. The question says that you have the free cash flow of the firm of 54 lakh. So FCFF of first year 54 lakhs given. Using this cash flow, you have the growth rate of 9% given. And using some KO which has not been given, you have calculated the value of the firm. So FCFF 1 given, KO given, growth given. Using the Gordon's formula, you have the value of the firm which is calculated at 1800 lakhs which is given to you. But they say that while doing this calculation, you first calculated KO. And for calculating KO, KD and KE has been given 20% and 10%. But the weights which are being used to calculate KO, what is KO? Cost of equity, weight of equity, cost of debt, weight of debt. The K and KO, the weight of equity and the weight of debt has been taken considering book value, which is the mistake we have made. So what is the mistake? Weight of equity and weight of debt, which are not given to us, are being taken considered book value. Because of which the KE, KD when multiplied to them gave me a KO which is incorrect, which is why the value of 1800 so arrived is incorrect. So if I have incorrect value, using that I will back calculate incorrect KO because FC, FF and G is there. Using KO I will back calculate incorrect weights. Now examiners say a line. It says value of equity is 3 times its book value, whereas value of debt is 9 by 10 times of its book value. The incorrect weights when you back calculate. Then examiners gives you a hint to correct them. For example, let's do the calculation now. Sir, if I have value of the firm of 1800 given, FCFF 1 of 54 given, growth of 9% given, what will KO be? Sir, 54 divided by 1800 plus 0.09, KO is 12, which is incorrect. Right? Incorrect KO. So I know this KO is somewhere the weighted average of this. So can I back calculate the weights? Sir, if KO is 12, I know cost of equity into weight of equity plus cost of debt into weight of debt, where weight of debt has been taken as 1 minus weight of equity. So please observe, if cost of equity, cost of debt given, KO given, can I back calculate the weights? Yes sir, 20% equity, 80% debt, fine. But these are incorrect. So now let's do the correct calculation. Equity is 3 times the book value, so 0.6 is equity. Debt is 9 by 10 times the book value, so 0.72 is the weight of debt. Sir, if I have the correct weight of equity and debt, where KE KD are given, can I calculate correct KO? And using correct KO, using that FCFF and using that growth, can I do the correct value calculation? Yes, that is what this question is, if you realize. Perfect. So let's do it, people in the class. If I have been given the FCF, if I have been given the correct weights and correct cost of equity and debt, what will my correct KO be? Please observe a point. 20 and 80 sums up to 100, so they are percentage. But 60, 0.6 and 0.72 does not sums up to 100. They are not percentages, they are proportions. So how do you calculate the weights using proportion? So it's like you can think it like 20 is the cost of equity multiplied by 0.6 divided by 0.72 plus 0.6 plus 10 is the cost of debt into 0.72 divided by 0.72 plus 0.6. Do you observe what I'm saying? Cost of equity into weight of equity divided by cost of debt plus into weight of debt, where weights were absolute number proportions, so they are converted to the percentage. For example, 2:3 is basically 2 by 5 and 3 by 5, exactly the same way. Using this, if you solve the cost of revised cost, the correct cost of firm turns out to be 14.55%. FCF, correct cost, growth, you calculate the correct value of the firm, which is what this question was. The objective was not to solve it, but explain to you the rhythm of it on a lighter note. People, question number 38 gets done. The next question again we gonna solve is question number 42. Again, this is a question where I don't want to teach to you or solve the entire question, but only teach you the underlying background. Not to solve the entire question, but teach to you the underlying background. Please understand what this question is. I mean, sometimes rather than leaving the entire question, if we do a particular part of it, that question gives me a better clarity, a better understanding for you to solve at your home. Fine. What this question say is, questions say that Rolly wants to acquire Polly. So this is the balance sheet of the company we are planning to acquire. It has equity, share capital, retained earning, debenture, creditor, cash, debtor, inventory, plant, machine. It has everything. Fine. Polly will get 1 share of Rolly at current market price of 20 for every 2 share. Polly's, how many number of share do they have? Sir, 1 lakh. Share capital is 10 lakh. Per share face value is 10. So number of share 1 lakh. Right? If they have 1 lakh shares, yes, people in the class, if they have 1 lakh shares multiplied by 1:2 exchange ratio tells us that we need to issue to the company 50,000 shares of my own, where my per share price is 20. Polly will get 1 of Rolly for every 2 shares of rupee, 1 share of 20 for every 2 shares. So 50,000 shares will be issued for rupee 20. So 50,000 multiplied by 20 give me 10 lakhs as the total shares to be issued to them. What is more important in this question is to get the context of it, which is not clearly given by the question. So when I acquire you, I am the company Rolly, you are the company Polly. When I acquire you, I will give you the total 10 lakh rupees of purchase consideration by issuing my 50,000 shares. External liabilities expected to settle at 20,000 discount. This 6 lakh liability will be settled. This 620 liability will be settled at 20%, 20,000 discount, which means at 6 lakhs. Debtor and inventory are expected to realize 2 lakh. Polly will run as an independent unit. What they say, when I acquire you, I will pay off your liability. I will sell off your assets. Cash is already realized. Always remember, cash is always realized. Sir, it's already in cash. I will continue to use only plant and machine. All other assets I will sell. Your unit will run independently. Those plant and machine will generate me CFAT of 4 lakh for the next 6 years, and it will dispose the plant after 6 years at 150. Other assets were disposed today only. Plant will be disposed after 6 years at 150. For the next 6 years, I will generate 4 lakhs. Should I do the acquisition? Should I do the proposal of acquiring? Common sense is really simple. When I acquire Polly, let's find out net how much go out of my pocket. First, 10 lakh rupee of share consideration go out of my pocket. Then 6 lakh rupee in total goes out to settle the liability. So 3 plus 3 is 6 lakh. Total 16 go out of my pocket. But I today realize 2 lakh from debtor inventory and 20,000 of cash I immediately realize. So 220 I realize net that go out of my pocket. Effectively to acquire that plant is 13 lakhs 80,000. When I acquired that company, everything else I settled. What I ultimately ended up acquiring is that plant. So that plant gave me 1380. That plant led to 1380 outflow. What inflow will it give? 4 lakhs for the 6th year, 150 in the 6th year. Discounted at the rate of 40%, what is the present value of future cash inflow? Now apply NPV logic. Initial cost is this. Although entire cost is not in cash, but it is some value which has gone out of in terms of share. So initial cost is 1380. What every year will come is 4 lakh for 6th year and 150 in 6th year. So what is the present value of inflow? Minus initial outflow will give me NPV. Sir, 4 lakh into the annuity factor of 6th year and 150 into the factor of 6th year give me the 1623 inflow minus 1380 initial outflow. NPV positive, the project is feasible. Point of learning. Question did not specify. The question has to be done with this mindset. That is something you'll have to remember. Second, cash realization examiner did not talk about, but that's a hidden adjustment. You will have to always remember that in such questions, cash is people realized only. The amount I will immediately get when I acquire another company, that is the point you have to remember. Question 42 gets done. The next question, everyone, we solve is the next concept you will have to first learn. We are now moving to asset-based valuation model. We have done sufficient number of questions from this revision point of view of multiple variety. Sir, next is asset-based valuation model. Perfect. So let's do it. NAV of the company, net realizable value of the company or replaceable value of the company, you call it, everything you call is based on covers under this model. This time we try to value the company using assets of the company, which is again really simple. In the balance sheet, it has all the assets. Over the assets, the debtors, the debt has the first claim. So deduct outside liability, deduct preference, whatever will be left will belong to equity. The only point is, in NAV method, we should consider the market value of assets and liabilities. So market value of the assets and liabilities, if you consider, so market value of assets minus the value of liability and preference will give you the value of equity. Divided by number of share will give me per share value of equity. That simple is the common sense of valuation. If examiner asks for net realizable value, liquidation value, adjusted value, rather than market value, use NRV of the assets and liabilities, which is nothing but the market value at which you can sell it, minus if there is a cost involved to sell that asset or settle that liability, minus selling cost will give you NRV. When it comes to replaceable value, take the replacement cost given in the question. So whatever is the value relevant, take that value of assets and liabilities, automatically give you the final value of equity. Cool. Point. If the market values are not available, you will have to consider book value at all the places, right? Second, sometimes examiner may give you contingent liability. Even if the examiner is silent, make sure that contingent liability is also deducted when you talk about liabilities. Otherwise, what is the point of examiner giving you that? So contingent liability is also deducted. And last, also remember to deduct the preference shares claim, because we have to calculate only equity shares claim. People in the class, kindly respond to it. Am I able to explain to you this particular thing, which is asset-based valuation? Come on. Am I able to explain to you? If yes, we are all set to do the practical question of this. Let's solve one particular question, question number 47. The question from the study material actually. Yes. Again, the story is big. The question is simple. Let me explain and read only the relevant part for you. Initial data of the question tells you that the beta of the company is this. RF and RM of the company is 10 and 16. The growth rate of the earnings of the recent year has been 15 and 12 of the respective company. There are two companies, ABC, XYZ. ABC is planning to acquire XYZ. Now, when you acquire a company, you have to pay some price to that company, for which you will have to first value the company. For valuation, there are two methods. First, price based on net worth as per balance sheet. So net worth is basically that net asset model as per balance sheet after adjusting the current value of the asset. If there are any assets whose current value has not been calculated, first you calculate the current value of the assets and estimated after tax profit for the next 5 years. You have to adjust two things. First, the current value of the asset, and after tax profit for the next 5 years, you also adjust. Sir, what do you mean by adjust? Add it. Add the profit for the next 5 years to the net worth as per balance sheet and the current value of assets. And that's how you will consider the value of the company. That's how you will calculate the value of the company. Another method is used dividend valuation model using existing growth estimate of 15 and 12. So I can value the company using RM, RF, beta, cost of equity, growth, dividend. I can value the company using net worth, asset and liabilities. Agreed? We have to find the value and we have to also find the premium over current market price that I have to pay. When I acquire you, your already market price, for example, is 50. Will I pay you 50? No. I'll have to pay something extra to motivate you, for example, 55. So that 5 rupee that I extra pay, 5 rupee that I pay is premium over current market price. So we have to find the premium that should be paid using these two models. We have been given the assets of both the companies, the liabilities, assets of both the companies and the liabilities. There is an ambiguity in this question which will get rectified whenever this question is asked next, where the loans, which is the liability, has been mistakenly shown in the asset side. If you bring 5200 and 1000 here, then only the balance sheet total will match both the sides. Cool, sir? Fine. So basically you have to consider it here. Dividend payable, let me tell you, belongs to equity but is still a liability. You have to remember this. Sir, P&L has been given. By net profit, interest, tax, distributable profit. The terminologies used are not appropriate. From the EBIT, when you deduct interest and tax, you get net profit. And from the net profit, when you deduct dividend, you get retained earning. So what has been given as net profit is actually your EBIT because interest and tax has been deducted later. Fine. Land building of ABC, the acquirer company, land building has been recently revalued. The target company has not been revalued for the last 4 years, and during this period of 4 years, average growth of land building increased by 25% per annum. Every year the land building increased by 25%. Sir, 1500 is the current value plus 25% every year with the compounding effect for 4 years give me 1500 plus 25% plus 25% plus 25% and plus 25% is 3662.11 on a rounded off basis, the value of land building revised. Fine. Face value 10 and 25 is there, price per share 310 and 470 is there, you have to calculate premium. To compile the data given in the question, initially information regarding RMRF growth beta given, later on the balance sheet income statement given, then the face value market price and the growth in the land building given. You have to first apply net worth and profit model, then apply dividend valuation model. Net worth, I take all the assets one by one. ABC I don't need to take, I need only XYZ because I need to value and calculate the premium of only XYZ. Land building, current value, all other assets at their value. Land building, current value, other assets at their value. Liabilities, everything I have to take including dividend payable, including long-term loans. When you deduct liabilities, you get a net worth of 8362. But I need to adjust one more thing, the profit of next 5 years. At right now, my net profit, even if it says net profit, you don't take this number. You have to take the actual net profit, which is 1510, which will grow by 12%. You have to take the net profit for the next 5 years, right, which is growing at the rate of 12%, right? For XYZ, it is 12%. So let's take the 12% growing next 5 years profit. 1510 plus 12% is 1691.2 plus 12% is 1984. Similarly, the next 5 years profit totals up to this. So total value is this plus this divided by the number of share. If my total share capital is 1000, where per share value is 25. So 1000 divided by 25 give me 40 lakhs as the number of share. So this plus this divided by 40 lakhs. 8362.11 plus 10743.94 divided by 40 lakhs give me 477.65 is the value per share. As per this method, I should offer to you 477.65, where the price per share, if you realize, is 470. So I am giving you 7.65 rupee per share extra, which is my premium. How much in percentage terms? 7.65 I will give you extra on a base of 470, which is the price in the market. So in percentage terms, I am giving you 1.63% extra, if you realize. People in the class? That is what I am giving you extra. That is question number 47, which gets done. People in the class. Then everyone is the next topic you will have to first learn before solving the next question, which is earnings based valuation model. Yes. So let's do one thing. Let us take a break before learning this model, because we will learn the model, solve the practical question, and in the next flow, maybe we will complete the entire chapter. Cool? So just give me a second. So let's proceed to take a break first before we go on, right? So let's take a 15-minute break. 15-minute break, right? It is 12:05 right now. Let's meet back at 12:20 a.m. after the break. Yes, everyone. So see you all after the break. Then we continue the other concept and questions and then complete the entire chapter. The clarity with which we are covering this chapter is really very detailed and comprehensive, which is going to 100% help you in your revisions. Yes, boss. So see you all after the break, everyone. Bye. Perfect. So everyone, are you people all there? Shall we all proceed to the next concept, to the further questions of this chapter, earnings-based valuation model? Yes. So we have first of all learned how do we value the company using the dividends of the company. Then we learned how do we value the company using the cash flows of the company, then assets. Now we need to learn how do we value them using earnings of the company. Let me figure out if anything in the asset based valuation model is pending or not. Let me tell you one thing. One question that we have done, which is question number 47, this one which you see. A modified version of this question was being asked by the institute in the one of the attempts, which is November 20 attempt. When you look at both the questions, you will find that more or less they are same. They have the same ways the things have been written, that one company's building has been revalued recently, but another company's 3 years ago, 30% growth, etc. etc. Same, you have to find the premium. But a small change in the words changed the solution. And what is that word? Let me tell you. You are required to estimate the premium, determine the premium using net worth adjusted for current value of land building, fine, plus the estimated profit after tax for the next 5 years. So you have to understand the difference. If you observe the previous question that we had done, there it said estimated after tax profit for the next 5 years. So we took the profit of next 5 years. In the next question, which was asked by the institute in November 20, it says estimated average profit after tax for the next 5 year. Profit after tax for the next 5 year, but the average, this word average changed the situation. Sir, whatever was turned out to be the profit for the next 5 year was averaged out by dividing by 5. And that average number was being added to the net worth, people, if you realize, to the net worth. Is what the difference in this and the previous question was, which is what I wanted to explain. Now we are back to the earnings based valuation model. In the earnings based valuation model, we have to cover two models. One is earnings capitalization. Second is Walter's model. Both the models are really easy. Let's take them one by one. Earnings capitalization is a very simple logic. It says you calculate the future profits of the company. The profits that company will be able to earn in future, you divide that with the capitalization rate, you get the value of business or value of equity as the case may be. Right, I'll tell you about that. Fine. Once you get the value of equity directly, life is sorted. If you get the value of business, you deduct the value of debt and preference so that you get the value of equity. Divided by number of equity share will give you per share value of equity. That simple is the logic. Correct? Basically capitalizing the profits, trying to find the value of the company using the earnings or profits of the company by dividing it with the capitalization rate. Question 1, how do you calculate future profit? Question 2, how do you get the capitalization rate? Question 3, when do you get the value of business and when do you get the value of equity directly? One by one. Starting with the calculation of future maintainable profit. If company give you the profit which it has earned, the reported profit if it gives you, right? If the reported PAT is given, make it pre-tax to find reported PBT. For example, examiner tells you that in this reported PBT, there were certain extraordinary gains and losses. Some exceptional items which are not expected to repeat in future. So if there is a loss which is already deducted in this PBT, I will have to reverse the effect of it by adding it. If there is an income already added in the PBT, I have to deduct it so that I can reverse the effect of it. So eliminating the things which are already included in PBT by reversing them. Now giving the effect of new additional income and expenses that will happen in future. So in future, if there is an additional income, you add it. In future, there's an additional expense, you deduct it. That way, you get the future maintainable PBT, the profit before tax you'll be able to maintain in future, minus the future tax rate give you FMP or future maintainable PAT, the final part you'll be able to maintain in future. This PAT that you will be able to maintain in future is used for valuation, divided with the capitalization rate. Capitalization rate can be given in the question as cost of equity, can be cost of capital, or can be given in the question as cost of equity. Right? If KO has been given in the question, the value so arrived is the value of business. If KE has been given in the question, the value so arrived is the value of equity. Depending upon the denominator, we try to arrive at the value of the business or equity, ignoring numerator. You may find it illogical, which is absolutely correct, but the institute has not covered this method with real depth. With the limited manner, it has, ignored the numerator. It has considered only the denominator. It also has some ambiguous questions as well. So considering everything, I'm trying to teach you the things not which are very correct, but the things that can get you marks in the exam, right? So future maintainable profit, how do you calculate is fine. Divided by the denominator, which is the capitalization rate, give you the value of business or equity. If the capitalization rate is not given this way, then it is calculated as your earnings yield. EPS divided by MPS is the earnings yield. Sir, why are you using earnings yield and not any other number? Boss, we are trying to value the company using earnings. So let's use the return, the capitalization rate, which is based on earnings, which is EPS divided by MPS. Sir, based on earnings, we also have ROE. But ROE is a number which is based on book value, and we try to value the company, we try to calculate the market value of the company. So use earnings divided by MPS means earnings yield or 1 by PE. Correct? So that is the entire story, which is really easy. Let me show that to you through a practical question. So one practical question that we must do is question number 52. Right? So let me tell you, starting with the other questions as well. 49th we are not doing, but it's a good question, you should do, it will help you. The only ambiguity in this question is that examiners say profit for the current year was rupees 64 lakhs, which include 4 lakh extraordinary income and 1 lakh other income. When you read the question, you are not able to figure out which profit is given. If you feel PBT, your life is sorted because institute assumed PBT. As a student and as a teacher, I sometimes feel it that it's PAT is given. So when PAT is given, you have to divide it with 1 minus T to convert it to PBT. In this case, you have to assume PBT. That is a kind of ambiguity this question has. You will have to kind of remember this. Yes, that was question 49. Next question we're gonna do is 52nd question. This question we will solve in the class. A similar nature question is also there, 51, which was asked by the institute in May 19, which you will have to cover at your own. 52, let us solve. Logical, but a small, again, kind of ambiguity it has. Don't be worried that, sir, there are so many ambiguities, I understand. Whenever you revise that ambiguous solution, automatically you will be able to recollect it, or maybe automatically you will be able to remember it in your brains. Yes, please. So let us proceed. People in the class, please pay attention. XN Limited reported a profit of 100.32 lakhs after 34% tax for financial year 15-16. So PAT after tax of 34% given. An analysis of account reveals that income included extraordinary item of 14 lakh and extraordinary loss of 5 lakh. The income includes extraordinary incomes and losses, existing operation except for extraordinary to continue, future new product launch which have sales and cost like this. Company has 50 lakh equity share of 10, 80,000 9% preference share of 100, P ratio 6 times, compute the value of business, cost of capital 12%. We have to compute the value of entire business first, right? You don't have to think of deducting equity or preference or anything. The total value of business you have to find out. So you need FMP divided by you need the capitalization rate. Sir, future maintainable profit 100.32 is PAT. So 100 minus 34 is 66%. So 100.32 divided by 66% is 152 as your PBT. As your PBT, which includes 14 lakhs of income, so minus 14, which includes the loss of 5, so plus 5, future 143 I get, 143 I get. If I talk about the future income, so 143 M plus, then 70 minus 20 minus 16 minus 10 is 27 M plus, give me 170 of future. Why 167? Okay, so maybe this a number I have 170, just hold on for a minute. 30, 36, 24, 143 plus 24, 167. Anyway, so 1 crore 67 lakhs is the future maintainable PBT I have, from which 34% of tax when you deduct, you get future maintainable PAT of 1022, which if you divide by the capitalization rate of 12%, you get the value of business. So 1 crore 10 lakhs 22,000, 1 crore 10 lakhs 22,000 divided by 12% give me 9 crore 18 lakh 50,000 as the value of overall business. That is what institute has been asking. In the second part, it says determine the market price per equity share. When I read this particular question, in my mind, you know what flow do I get? I get that if the value of business has been given, let me deduct the value of preference from it, then value of equity will be there. Divided by the number of share will be market price per equity share. You will have to remember that there is a difference between market value and market price. Although the two terminologies are interchangeably used, so what I say does not have 100% relevance, but a way to remember it, sir, market value or the value is what you calculate, price is what is there in the market. When they ask you the price, you have to calculate the price which prevails with the help of P/E ratio. So if I can somehow get EPS and multiplying will give you the MPS, sir, no one would ever think of this if this information is given. That is correct, which is why practicing question at home is important so that you can recollect for at least the typical questions their way to solve it. Right now in the EPS, what is the ambiguity? Rather than considering the reported PAT, they have considered the future maintainable PAT. That in future, how much is the amount of PAT company will be able to maintain, that future maintainable PAT has been used by the company boss. Are you people realizing? So it's 1 crore 10 lakh 20,000 is the PAT, from which if we pay 9 rupee dividend on 80,000 share, it gives you 7,020 rupee of dividend, give me 1 crore 3 lakh 2,000 divided by 50 lakh number of share, EPS into P/E ratio is the MPS, which is 12.3624. That is question number 52, which gets done. Yes. So 52 question on earnings based valuation model we have to do. The next discussion people we will do will be on the Walters model. So I hope everything related to this is clear to you. In one of the questions, institute asks you to first calculate earnings capitalized value method, value per share. It will ask you to calculate NAV per share, and ultimately it will ask you to calculate the fair price. So the fair price, everyone, is nothing but the average of two values. Sir, what is this? Fair price is the fair value, agreed. But specifically for the question of earnings capitalization value or NAV value, if you hear this word fair price, you will have to calculate average. If the weights are given, you do weighted average. If the weights are not given, you do simple average. That is what is the plan. Correct? There is a question I want to tell you. This is a typical, extremely typical nature of question, which is category B. Not A category, because the type of effort it will take not to do it, but also to remember it, retain it, reproduce in the exam is very much, and the probability of being asked is less. But since it is a study material question for very long, you should at least do it in category B, right? So anyways, 53rd question you will have to do. Next situation we are discussing is the Walters model. Institute has not asked any question from Walters for very long, right? I mean, there is a doubt with respect to this question being there. in the curriculum or not, this topic being there in the curriculum or not, because in 2018 the curriculum was modified. The topics related to dividends were removed, but Walters was not removed. This is why we are doing it, and we will do a practical question of it. Walters models say that if you want to value the share, you have to make use of earnings of the company. Fine. Whatever EPS that company makes per annum ultimately go to the shareholder, belongs to shareholder, yes, but they don't reach to the shareholder as it is. The part which is distributed reach to the shareholder in the form of cash, but the part which is not distributed does not reach to him. How does that part reach to the shareholder in terms of income? The share price increases, the value of the share increases. So theoretically, the part which reaches to him is dividend. The part which is retained is called as EPS minus DPS, E minus D. EPS is 5 rupees, 2 rupees distributed means 3 is retained. Does that mean the share price will increase exactly by 3 rupees? No. The share price, people in the class, will increase by 3 multiplied by ROE divided by cost of equity. Common sense is, on this 3 rupee that we retain, if we retain and invest in the future years, how much is the amount of return I will earn on that retained earning when I invest in the business? If the ROE is 10%, I will earn 0.3%. And that 0.3 if I earn every year, if I capitalize that income, suppose the K is 12%, so 0.3 divided by 12% give me 2.5 rupee as the value by which share price should increase in the market. By retaining 3 rupee, the share price will increase by 2.5. So company retained 3, but the value that could reach to the shareholder by their capital appreciation is only 2.5. Why? Because 3 multiplied by 10% and divided by 12% gave me 2.5 as the increase in the share price. So to you as a shareholder, 3 rupee you received a dividend and 2.5 was the increase in the share price against the income of 1 year. Now when you receive this EPS every year, this is the value or income you will generate every year. And when I capitalize the income earned by you 3 plus 2.5 every year, this income of every year divided by the capitalization rate of 12 give me the value of share. Are you people please understanding this? What do you say? What do you say? Everyone. So what do we say? R is the ROE, and if equity is the only investment, no debt, then ROI is ROE. K is cost of equity, you calculate it using CAPM or any other capitalization rate. Sir, if you observe in the entire formula, there is no growth. Sir, this concept does not only ask you to calculate the value, it also asks you to suggest the dividend policy. Meaning to say, what should a company do? So, should the company retain? Let's apply common sense. R is I am a company. When you give me money, you expect me to pay to something to you called as cost of equity to me. The return that I pay to you is KE. When you give me money, I invest an amount in the market. The amount that I receive from there, the amount that I receive when I invest in the business, the return I generate from there is ROE. So what I earn is ROE and what I pay to you is cost of equity. Now apply common sense. If ROE is more than cost of equity, what I receive is more than what I have to pay to you. So better I retain your amount and invest it in the business. Sir, if ROE is more than KE, then 0% I should pay to you, 100% I should retain. But imagine a situation that what I earn is less than what I have to pay to you. So I earn 8 and if I have to pay to you 10, is there a point of retaining? If I retain, I'll earn less, and on that retention I have to pay you more. So it makes sense to pay out 100% in this case, and if the two are equal, I am indifferent. So examiner not only ask you to do the valuation, but also ask you to guide the optimal payout ratio using this. And if it asks you to guide the payout ratio, then please observe, not only you will have to guide, but on that guidance of that guidant payout ratio, you have to again find the value of the share. For example, you saw the payout is 0. Then assuming a zero payout, you do the valuation again and show them this is the best value you can get. Are you all please understanding it, people in the class? Tell me. So with the with that, we can do a question of Walter's model. 54th is actually an easy question. Since we have learnt that much, let's do 55 question of this. Come on. Earnings of the company 10 lakhs, dividend payout ratio 60%, number of share 2 lakh, ROE 15%, capitalization rate which is K is 12%, market value per share. So EPS is 10 lakhs divided by 2 is 5 into DPS 3. So 3 plus 5 minus 3 into ROE 15, ROE of 15 and KE of 12, ROE of 15 and KE of 12. This is the earnings that a shareholder will get every year. What if those earnings are capitalized, which means again when divided by 12%, what do you get? 5 minus 3 multiplied by 15% divided by 12% plus 3 divided by 0.12 gives me 45.83 as the price. Next, they are asking what is the optimal payout. So we will say if the ROE is more than KE, then 0 you should pay, 100% you should retain, and in that case what will be the value? 0 you pay, entire 5 you retain. Into 15 by 12, 4 divided by 12% give you 52.08 as the value, which is what they wanted to tell them. With the change in the payout, the value increased. The third part is theory, you'll have to do at your own. 55th, the basic question with the application of Walter's people in the class we have discussed. The next is learning the next concept, which is everyone, relative valuation. The relative valuation, which is sometimes directly asked by the institute, as I was the institute in September 25 exam. Sometimes institute use this concept as a part of, test this concept as a part of some other concepts in some other chapters, right? Relative valuation has a very simple logic. Based on the parameter of my company, financial parameter of my company, multiplied by a ratio. A ratio is also called as multiple. What is the alternative word for ratio? Multiple. So financial parameter of my company will multiplied with the ratio or a multiple of the industry or my competitors or my peers, I can get my value. Common sense was really easy. When industry PE ratio is 25 times, it implies that every 1 rupee of EPS earned in the industry, people are ready to pay 25 rupee of price. So if my EPS is 60, how much price people should be ready to pay for me? It is 25 multiplied by 60. 60 is my financial parameter, 25 is the ratio of the industry, and multiplying the two will give me the value of my company. The only point is comparability. If you are using your EPS, the ratio should be price to earning ratio. If you are using your book value per share, the ratio should be price to book value per share ratio. Comparable, right? Sir, two possibilities. Either I can use equity value multiples or equity value ratio, or I can use enterprise value multiples or enterprise value ratio. Equity value gives me the value of only equity shareholder, enterprise value gives me the value of all the capital providers collectively. So EPS, if is the financial parameter multiplied with P ratio, book value per share is the parameter multiplied with price to book value ratio. If sales is the parameter, multiply with the price to sales ratio. Could you observe? The numerator of all of them is equity value equity value, which is why these ratios are called as equity value ratios, because numerator are equity value. So the parameter multiplied by the ratio gives me the value of equity directly. Similarly, enterprise value, the value that belongs to all the capital providers collectively. Please understand, if I have been given EBITDA, right? So for example, price to earning ratio, if you imagine, denominator was earning of equity, numerator was price of equity. So if I talk about enterprise value, I have to talk from the perspective of everyone. So in the denominator should be the earnings of everyone, which will be EBIT or EBITDA, right? So in the denominator, sorry, if I talk about a ratio is EV to EBITDA, ratio is EV divided by EBIT or EBITDA. So in the denominator will be the profit of everyone, and in the numerator will be the value of everyone, correct? EV divided by EBIT is EV to EBITDA ratio, EV to EBITDA ratio, depending upon whether you want to use EBIT or EBITDA. Sir, if you use this ratio or this multiple, you will have to use your company's EV or EBIT, EBIT or EBITDA as the financial parameter. So logic remain the same. Financial parameter of your company multiplied by the ratio of the comparable firms. If EV to EBIT ratio is the ratio you are using, EBIT is the financial parameter you will use. If EB to sales ratio you are using, sales is the financial parameter of your company. We will have to use the things should be aligned is what I'm saying. Please observe the numerator of all of them is the enterprise value. Yes. So when you multiply the two things, you will get the enterprise value. The enterprise value that you get through this is a fair enterprise value. That this should be the enterprise value of the company. For example, the value of equity that you get through this is the fair value, that this should be the value. What is actually the value is a different thing. Similarly, this should be the value of equity, this should be the value of enterprise value. If I have the enterprise value which is fair, so from that enterprise value, so now let me tell you one thing. Now this is a fair enterprise value. Before that, let me try to teach to you what is actual enterprise value. Enterprise value actually represents the total market value of all the capital providers. For example, this is the market value of equity, calling it market cap, plus the market value of debt, plus the market value of preference is the market value of all the capital providers. The only thing people in the class to remember is that you deduct the value of cash and cash equivalents from that. What do you deduct? The value of cash and cash equivalent from that. So that is how people in the class, you calculate enterprise value. Sir, what is the logic of deducting cash and cash equivalents? We are not discussing it right now. We have discussed it in the class. Perfect. So adding the three, deducting cash gives me enterprise value. So this is the actual enterprise value that prevails in the market. If someone asks me to calculate the fair enterprise value, this is one of the way to calculate fair enterprise value, which is financial parameter multiplied the ratio of the industry give me fair enterprise value. So if I have the fair enterprise value, I know it is the collective value of all of them minus cash. So if I add cash to it, if I deduct preference and deduct debt from it, will I be able to get the equity value at least which is fair, right? So fair enterprise value minus debt minus preference plus cash give me fair market value of equity as per relative valuation. That according to the logic of equity valuation, according to the logic of enterprise value valuation, the fair value of equity should be this. Actual value in the market will be something else, that is possible, but fair will be this. This is the logic we use. Everyone, are you all able to connect? Yes. So sir, with that, let me take you to a practical question which was being asked by the institute in September 25 exam, and that will give you the clarity. In your book, that question will be somewhere in the section of relative valuation, right? However, right now, the outscanner is not fully updated. So I have compiled all the new questions in the initial pages of the outscanner, taking you to the first question, which is September 25 exam paper question of relative valuation. Everyone. Number of equity share is 1,50,000. The current market price per share is 12. 10% debt is 2 lakh. Cash and cash equivalent 5 lakh. Gross profit 12 lakhs. Indirect expense which exclude depreciation is and interest is 5 lakh. Depreciation 30,000. RF, RM, beta tax rate given to me. Cost of equity of the company I have to find out. Extremely easy. If I have RM, if I have beta, what is the cost of equity? 16 minus 7 multiplied by 0.8 plus 7 is 14.2 as the cost of equity. 14.2 as the cost of equity. Correct? Next, people, is earnings per share of the company. Boss, what about the EPS of the company? Sir, for EPS I need PAT. Has the question given me PAT? No. Has the question given me the gross profit? No. What do you have to do? Sir, from the gross profit, if you deduct other expenses, you get the PAT. When divided by number of share will give you EPS. So if your gross profit, people, is 12 lakhs, let's deduct other expenses. So from the gross profit, indirect expenses 5 lakh, 12 minus 5 give me 7 lakhs. Depreciation of 30,000 give me 6,70,000. On 2 lakh rupee, interest at the rate 10% is 20,000 give me PBT of 650. 20% tax give me PAT of 520 divided by 1,50,000 share give me earnings per share of 3.47. The first two parts were really easy. The next two parts are also easy but worth learning. Sir, equity value of the company, have to find out if EBITDA multiple is 4. They have not given me equity multiple. They have not given me P ratio. If they give me P ratio of 4, to the EPS I multiply P and I can get the MPS. They have given me the EBITDA multiple. The word EBITDA multiple means, the word EBITDA multiple, people in the class, means EV to EBITDA ratio. EV to EBITDA ratio means actually EBITDA multiple. So if I have EV to EBITDA ratio of 4 times, if I have EBITDA of the company of 7, can I multiply 4 with 7 to find out the enterprise value of the company? Yes, sir, 4 multiplied by 7 give me enterprise value of the company as 28 lakhs. In this enterprise value, I know the value of debt is included. So if I eliminate 2, if I add 5 to it, I will get the equity value of the company. I have to get the equity value, but using the enterprise value. And the enterprise value that we have calculated through the formula is the fair enterprise value. From the fair EV, if I deduct debt and add cash, I get fair equity value. But you know what is the problem? The ambiguity in this question, first of all, is that institute missed to consider the cash, which should ideally or logically be considered here. That is the ambiguity, unfortunately, of this question. Yes. Sir, next, what is the enterprise value of the company? Sir, I just calculated enterprise value. Why would institute ask me to calculate again? Sir, what you had done was a fair enterprise value. If they are asking you to redo it, it may now be the actual enterprise value. Sir, if I have the actual market price of equity share, the actual value of the debt, the actual cash and cash equivalent, can you find the actual enterprise value? Yes. 150 into 12 give me 18 lakhs of equity, plus debt of 2 lakhs minus cash of 5 lakhs. 18 plus 2 is 20 minus 5 is 15 lakhs of enterprise value, which, people in the class, if you realize, is actual. And that is question number 1, which belongs to the variation of this gets done. Question 1 was really a good question of equity business, of enterprise value based valuation gets done. Let me take you back to the chapter of equity business value and find out if there is something else we can find. Just 1 second. So there is this particular question, question number 60, which you must do. Reason that, I feel bad when I say that this question is ambiguous, that is ambiguous, but institute unfortunately has those questions which it asks in the exam, and that too with the ambiguities, and allot you marks only when you solve them in an ambiguous way. 60th is an easy question but has an ambiguity, so you must consider solving it at your own. Right? Another good question is question number 66. Question number 66. This question also has the concept of portfolio management used in it. So if you already know portfolio management, you will be able to understand that particular step. If no, then you won't be able to understand it. Starting to do it, people in the class, please pay attention. There's a privately held company which is operating in the retail space and now scouting for angel investor looking to get its valuation. Company has achieved break-even this year, has EBITDA of 90. Unlevered beta based on industry is 1.8. Unlevered beta. Do you remember from portfolio management I taught you unlevered means what? Unlevered, people in the class, means acid beta. So acid beta is 1.8, average debt to ratio is 40/60. With a ratio of 40/60, the beta is 1.8. The rate of return provided by liquid bond is 5%, RF is 5, EV to be taken at 5 on EBITDA, EV/EBITDA multiple is 5 times. Accounted informed that EBITDA of 90, this one, include gain of 10 and potential write-off of preliminary sales of 20 is still pending. Some gains and losses are yet to be done. Internal assessment of the industry says market is 11% return, free cash flow for the next 3 years are given, cost of debt 12, assume tax rate 30, potential value of X limited. How would you value X limited? Based this data, do you feel the data is really very open-ended? It gives me the detail of EBITDA. It gives me the detail of EBITDA multiple to be applied. It gives me the detail of extraordinary gain loss which relates to earnings based valuation. It gives me the detail of FCFF. Due to its randomness, we are discussing this question in the class. I would 100% agree that examiner is not clear about how should the valuation be done. But let's think about what it is 100% clear about. If EBITDA is given, EBITDA multiple is given. And when say EBITDA includes extraordinary gain loss, it means you have to eliminate them, right? So EBITDA is 90, from which 10 extraordinary gain eliminate, 20 unamortized expense eliminate, 60 is the future maintainable profit. To the EBITDA multiple of 5 give you EV/EBITDA ratio when you apply, give you 300 rupee the value based on that. Next, sir, if future cash flows are given, you have to discount them. To discount the future cash flows, you need discounting rate. Sir, if KD is given, then you have to assume the cash flows to be FCFF because you have to first calculate WACC, then discount it. For WACC, you need KE. For KE, you need beta. You don't have your company's beta, you have the asset beta. So, do you know the weighted average logic? Beta of equity into weight of equity plus beta of debt into weight of debt give you the beta of asset. If 1.8, which is the beta of asset given to me, beta of equity I can back calculate. If the weight is 40/60, please look at this. Weight of average debt to equity is 40/60. Equity is 60 divided by 60 plus 40. Debt is 40 divided by 60 plus 40. But since beta of debt is 0, this entire terminology becomes 0. In the denominator, always remember, whenever you have debt, you have to multiply 1 minus t to it. In the denominator, it is 0.5 into 1 minus 0.3. This gives me to the formula to back calculate beta of equity. Because beta of equity is the beta of asset is the weighted average of equity and debt. If I have the asset beta, the weights, can I back calculate beta of equity through this equation 2.64. Beta into RM minus RF plus RF, which is given in the question, gives me 20.844 as the cost of equity. And now I'll proceed to calculate WACC. Post pre-tax KD is 12. So 12 minus 30% is post-tax KD into weight of debt 40 by 100. Cost of equity into weight of equity 60 by 100. Please remember, only for calculating beta, you multiply 1 minus t. For the purpose of WACC, you never do it. Yes. So the weighted average cost of capital will be 15.864 and the three cash flows, when you discount at this rate, the value turns out to be 272.5. Perfect. So average, or maybe they are, again, this is not clearly specified by them, the potential value means what, but the institute has done the average of 2 as the average value that can be considered. The point I want to tell you people in the class is that this was actually not even a question. This was the illustration in the study material by the institute, but through the, see, illustrations are never clear because they are not testing you, they are trying to teach you something. This illustration can be asked in the exam, a question can be created on it, which is why we did it from the point of view of question. There is a strong possibility when this question is asked, they will be more clear and specific about it, that you have to calculate value using this method, that method, etc, etc. Having said that, right now we have done it question number 66 to get the needed conceptual clarity. Perfect, everyone in the class. Does that make sense? Next discussion is on a particular question, a brilliant question, question number 69. Actually, the concept of this question does not belong to this chapter. It belongs to the chapter of external fund requirement. It belongs to the topic of external fund requirement. The chapter is financial policy and corporate strategy. This question in the study material you will find in the very first chapter, the theory chapter, right? Underlying logic of this question, I will explain you once we start to read the question. So let's look at this, people in the class, let's look at this. The balance sheet of Messrs. Sundry Limited as on 31st March 20 is as follow. What is the balance sheet? Sir, fixed asset, inventory, receivable, cash has been given. Share capital, reserve, long-term loans and payables are given. Yes, everyone. So if these liabilities and assets are given, examiners say the sales for the year was 600 lakhs. The years that have just passed had a sales of 600 lakhs for which the balance sheet was this. Now look at the interpretation of this question. The sales are expected to grow by 20% during the year. In the coming year, in which we are right now, which is not over, in the year in which we are right now, the sales will grow by 20%. We are expecting as compared to the previous sales. Profit margin and payout will be 4 and 50%. In the year in which we are, 4% of sales will be margin, 50% of which we will distribute. Cool. The company further desire during the current year sales to short-term loans to payables and provision. Ratio should be 4:3. Sales divided by short-term loans plus payables and provision. This ratio is 4:3. Similarly, sales ratio of fixed asset to long-term loan should be 1.5. Fixed asset to long-term loans should be 1.5. These are the two ratios that should be maintained in the year in which we are. Debt equity should not exceed 1.5. That is also clear. You are required to determine the external fund requirement. Take 20 seconds. 20 seconds to reread the question to understand what is examiner trying you to answer. I mean expecting from you to answer. Please reread the question for 20 seconds. And give me a minute to have water. Then I'll explain it. Yes, people. There. So the point which brings a question to my mind is that examiner or the question nowhere specified that you need to make an investment in a project, which is why you need money and which is why how much fund should we raise from the external parties. It does not specify any such thing. Then why would there be a fund requirement is the main point I want to explain. The question does not specify. You may mark it as a typical question, but is illogical. The context is that there is this assumption in finance that when the sales of the company grows, proportionately the entire business of the company has to grow. Meaning to say, as you grow, sell more, you would need more assets to manufacture and sell more. You would need inventory or debtor, more cash requirement, and in fact the creditors and the other payables in the business will be more. Meaning to say, according to the sales, all the operating assets and the liabilities of the company will increase. Correct? Now, when these assets will increase, meaning to say the investment in the assets will increase, where would the money come from? From this capital providers. Now you have a choice. How do you want to raise money from them, from equity, debt, or whatever combo? But the fund will in that case increase, which is what they are asking. That in the previous year, this was the balance sheet, this was the sale. In the coming year, sales has grown or is expecting to grow by 20%. So all the operating asset liability expected to grow by 20%. So overall, that additional 20% will be the additional capital requirement I will have by the end of this year. That simple is the thought process. Sir, how much is as of now the capital employed in the business? Operating assets 1400 minus 200 liability. The capital employed in the business is 1200. If sale grow by 20, the capital employed also grow by 20%, giving me the additional fund requirement of 1200 into 20% as 240. 240 is the additional fund requirement. Boss, that 240 which you require by the end of this year additionally, where will it come from? Externally, not entirely. Please let us do this. By the end of this year, my sale will be 720, 600 lakhs plus 20%, 720. Of which 4%, so 720 multiplied by 4% is 28.8 as my profit. Of which 50% will be paid out, which means rest of 14.4, which is 50%, will be retained. So by the end of this year, I will need a total of 240, from which 14.4 is internally generated by way of profit which is available with me. So how much is the additional capital you need to raise from the outside parties externally, including equity, debt and everyone? Sir, only 240 minus 14.4, 225.6 is the answer. First part of the question, logical, but a bit difficult or in a different side to think. Second part of the question, amount to be raised from short-term, long-term and equity fund. How much amount will you raise? So now we have to make the use of ratios in the coming year. They say the ratio of sales to short-term payables provision should be 4:3. So in the coming year, sales are going to be 720. Short-term loan will be ST plus payable provision with 20% increase will become 240. This should be equal to 4:3. Now when you solve it, or you can think it this way, sales 420, expected short-term payables and provision accordingly should be 540 according to the ratio, in which the expected only payable and provision are going to be 240. So the short-term loan expected for the coming year end should be 300. At present also they are 300 only. Are you understanding? From the sales, using the ratio, you find out how much the payables, short-term loan payable provision should be. Payable provision, how much will it be? 240 with the increase in sales, 200 plus 20%. So loans should be 300 and they are anyways 300. The amount to be raised from the loan is 0. Otherwise the ratio will get disturbed. Ratio you have to maintain. Fixed assets which are 600 are expected to be 720 with the increase in growth. So using the fixed asset to long-term loan ratio, we feel that the long-term loan should be 480. Present loan for the previous year ended was 400. So new loan to be raised in the current year is 80. So out of 225 that I need, short-term I need to raise from short-term is 0. I need to raise from long-term is 80. So rest of it is to be raised all from equity, which is 145.6, the balancing figure. Right? One particular part of this question is missing in terms of presentation, which is simply presenting to the institute that debt to equity ratio, if you calculate after the raised numbers, which means revised debt will be short-term 300, long-term 400 plus 80, 480 divided by equity, existing equity plus the new equity retained for the next year plus the new equity raised this year, right, will give me the total equity. Just show it to the examiner that the debt equity ratio has not increased by more than 1.5 times is what this question 69, a really good question about. Perfect. So this question did not belong to any particular method was the question, right? The next category is other important topics. After learning the 5 methods of valuation, people, we will now learn the other things related to valuation, starting our discussion with economic value added and market value added. Please look at what I'm trying to explain. Economic value added is a really simple concept. It says I am a company. You people are collectively the capital providers. You people give me money using which I do the business. I use that money, I take that money, invest it in my business and earn the return. And that return I try to distribute back to you because when you give me money, you have expectations. Cool. The amount that you give me is called as capital employed. On that amount, the return that you are expecting is called as WACC, correct? So on the capital that you give me, you are expecting a return called as WACC. That capital, when I invest, the profit that I earn, the operating profit I earn is EBIT. But after tax, that profit become EBIT into 1 minus T, which is NOPAT. From that operating profit, I will pay to you people the finance charge, which means the WACC, weighted average cost of capital. Different people gave me money with different expectation. So as a whole, what was your expectation on the capital employed that I pay to you, that I deduct? So the balance which me as a company could generate extra over and above after paying to you is called as economic value added. This ultimately will belong to equity only because balancing figure, residual amount is all equity owned. But the point is, this is how much we could generate extra is called as economic value added. Now one by one. EBIT, easy to calculate, right? 1 minus T, done. Sir, what about capital employed? Although the institute is not really clear when does it take book value or market value, but primarily it does take book value. But whenever it comes to taking the book value, please understand, suppose the company says we have the value of the asset is this, but in the book value of the asset, a particular asset has not been considered, or the asset's market value has been this. So you have to find out the capital employed, for which the value of asset, if the market value is given, you have to use that market value. Meaning to say, how do you find the capital employed? Maybe equity debt preference, or maybe all your asset minus current liabilities. So in the assets, you have to take the market value if you are following the asset side. Asset side, take the market value asset minus liability, give you the capital employed. I'm not asking you to take the market value of equity, market value of debt and preference. I'm asking you to take the market value of the assets as per balance sheet minus the liability. So that is capital employed. Equity plus debt plus preference. WACC, you know, KE, CAPM is there. KD, interest rate into 1 minus T is there. WACC, the weights, absolute and percentage relative weights are there. Yes. So capital employed is fine, WACC is fine, everything is fine. We can now proceed to calculate economic value added. So I think the first question we can do of this type. Let's take an easy question, question number 70. It will give you comfort. It will also help you understand the concept of market value added. Should I repeat the concept of market value added once? It's like market value of all your capital providers minus the book value of all your capital providers. Over and above the book value of equity, debt and preference, how much value do they have in the market? Is the market value added such a simple concept? People in the class, question number 70 is what we must do right now. Yes? So let us proceed. Everyone in the class. Sales 1 lakh rupee, operating expense which include interest also is 620 lakhs, 8% debenture 250, equity share capital 250, reserve surplus 250, market value of the entire company is 900. Corporate tax rate, risk-free rate, market rate of return, equity beta. So tax, RF, RM, beta has been given. Calculate weighted average cost of capital. Weighted average cost of capital you have to find out, WACC. So for WACC, I need KD, KE, WD, WE, that's all I need. Sir, do I have KE with me? Yes, very easily. So 12 minus 7 into 1.4 plus 7 is 14 KE, sorted. Sir, do I have KD with me? Yes. Cost of debt 8%, 1 minus 30% is 5.6 KD. Do I have the weights? Yes. Equity is 500 lakhs, share capital and reserves. Debt is 250 lakhs. So 500 divided by 750 and 250 divided by 750 become the weight of equity and debt, and the weighted average cost of capital become 11.2. Such an easy part it was. Next, it asks you to calculate the economic value added. Sir, what is economic value added? EBIT into 1 minus T. If I have sales, if I have operating expense including interest. So let's exclude interest to find EBIT. 8% of 250. 250 multiplied by 8% is 20. From 620, when you deduct 20, you're left with 600. So 1000 minus 600 give you 400 rupee of EBIT into 1 minus T. You don't need to necessarily create this table. You can simply do it here. 400 into 1 minus 30% into 750 capital employed into 11.2%. Correct? So 750 multiplied by 11.2%, if you deduct from 280 of NOPAT, you get 196 lakhs of economic value added. Economic value added. Perfect. Sir, market value added is simply the total market value of the company minus the total book value of the company of all the providers. So 900 minus 750 gives me 150 as the market value added. The first and the very basic question number 70th gets done. Yes. Another question that can be done on this is question number 78. 78 boss, right? Because 78 question tries to teach you a particular thing and it also has an ambiguity. 78 question says that if there is a non-cash expense other than depreciation, excluding depreciation means other than depreciation. So if there is a non-cash expense other than depreciation, if it is there, it should be added back to NOPAT while calculating NOPAT. Perfect. Sir, what do you mean to say? This particular thing actually has no apparent logic, but in one of the questions which Institute for the first time introduced in May 2018 asked, is there in the tutorial since then. Institute revised the solution of it to make it a better solution, but still is not the perfect solution. Let me tell you what this question is. Institute say revenue is there, direct cost is there, other cost is there, EBIT is there. Interest you deduct, you get EBT, tax you deduct, you get PAT. In the balance sheet, fixed asset, current asset there, equity reserve, debt and current liabilities there. Assume bad debt of 20 lakhs is included in SG&A. Do you agree bad debt is a non-cash expense? So in this amount, 20 lakhs is included as an expense. Same amount is reduced from trade receivable in the current asset. So obviously, what is the second effect of bad debt? You show it as an expense in the income statement. Also in the balance sheet, you deduct it from your assets. Correct? So fine. Also assume pre-tax KD 12%, tax rate 30%, cost of equity 8.45. You have to calculate EVA. Yes, please. Let's take it one by one. So everyone in the class, let's take it one by one. So people, first thing, as you see that I need NOPAT, I have EBIT. First of all, I will have to deduct the tax at the rate of 30% directly from it to calculate NOPAT. So 410 minus 30% is 287. But to that, you will have to add a non-cash thing of 20 to make it 307 as your actual NOPAT. Logically, we could have also said that first 20 should be added and then tax of 30% should be deducted, but this is what you will have to particularly follow in the exam. You all might feel that, sir, there are so many ambiguous questions, so particularly I am taking these ambiguous questions in this video, which is why you feel that there are so many. Normal questions I am not taking in this video. Are you realizing? I am taking less as compared to them. So and I would admit that in this particular section, which is EVA, there are some questions of this type. Okay ji? Cool. Sir, so first you deduct tax. Then you add back that non-cash expense to calculate the NOPAT. Fine. Next, NOPAT is there. Then I need to calculate capital employed. So sir, capital employed is 800 of equity and 100 of debt. But with that 20 rupee addition, so if you reverse an expense, cash will also the retained earning will also increase by 20, giving to you 820 as the revised equity balance, whereas debt continue to remain 100. Total capital employed become 920. Fine, sir. Logical. When it comes to calculating KO, KE 8.45 given. Pre-tax KD is 12. So 12 minus 30% give me 8.4 as post-tax KD. Now ambiguity is, rather than considering the weights of 820, so rather than considering 820 divided by 920 and 100 divided by 920, Institute ignored that 20 and considered only 800 by 900 and 100 by 900 as the weights for calculating back. So cost of equity into weight of equity, cost of debt into weight of debt give you cost of capital. Where that 20 rupee thing was ignored, which is an ambiguity. Sir, the main point is NOPAT of 307. Invested capital of 920, which is correct, into the WACC of 8.44, which is again incorrect, give me the economic value added of 229.35 lakhs. People in the class is the question I wanted to do with you all. Two questions of economic value added, people, we have done in this question, which is question number 78, where I wanted to teach you this. Two questions, one particular question 77 has that logic where a market value of asset of 100 crores is given, which is not recorded in the books. So when you record that asset in the book, your capital employed will increase. That is the logic you apply in question 77. Cool. Rest everything is fine, rest everything is logical, and this completes the discussion on economic value added. The next concept I would want to teach to you is concept of rights issue. Extremely easy and logical concept of right issue. Boss, what happens is that when my company needs money, I want to issue shares. Rather than issuing in the market, I give this option, a choice, a right to the existing shareholder that you can buy my share at a lower price. So those shares are called as right shares, which if they choose, I will issue to them. The right which I give to you, you have a choice. You don't have to compulsorily subscribe to my share. You have a choice. That is called as right. To the right, to the choice that you receive, you can either exercise, which means buy my shares. You can renounce, sell that right to someone else, or you can ignore the way you have been ignoring your teachers. Yes. So that, everyone in the class, jokes apart, is the right you receive, which can have three choices. Share already has a price in the market. For example, let's say there are 100 shares, or there are 1000 shares of 100 each. Existing share is called as N0, existing price is called as P0, let's say. So there are 1000 shares of 100 each. I am planning to issue, sir, I am planning to raise 20,000 rupee, where issue price per share will be 80 and the ratio will be 1:4. Sir, what do you mean by ratio? Let me tell you. Sir, 20,000 rupee I have to raise, where issue price per share is 80. How many shares will I need to issue? 250. 250 shares I will issue against existing 1000 share, which means, can I say, against every 4 share I will issue 1 share. So 250 divided by 1000 give me 1:4 as the issue price. Out of these three information, if any two are given, mostly in the exam any two will be given, I should ultimately be able to find out two things. Before right issue, there was a share price, there was a share number. On the day of right issue, I will issue the share at a particular price pre-1 and I will issue particular number of share N1. What examiner wants us to calculate is immediately after the issue, what will be the price per share, because now there will be more number of shares, existing plus new, collectively there will be more number of shares. So what will be that per share price of those more number of shares is the question. Yes, everyone? Yes, people, that is the flow or the rhythm of the question. So for that, you should first of all find out that how many shares of rights have been issued N1 and what is the price at which they are issued P1. For example, if examiner give me this and this, price is already there. Number I can find by 1000 into 1 by 4 as 250. Logical. If examiner give me this and this, 80 is already given. Number I can find out 2000 divided by 80, 20,000 divided by 80 as 250. If examiner give me this and this, number I can find as 1000 into 1 by 4 as 250 and 20,000 divided by 250 as 80. So any combination of these three informations are given. If two are given, I can find out basically N1 and P1 to calculate the price immediately after the rights called as X right price. The important calculation we have to do, which is very easy. Market price immediately after the right will be market value immediately after the right divided by number of share immediately after the rights. Extremely logical. This is the flow, not the formula I'm discussing. Formula is here. Let's first understand the flow so that we don't have to muck it up and it become the formula. Boss, post right market value is simply whatever is the market value before the right plus how much market value got added due to right. So pre-right market value plus the market value increased. It's simply the cash raised, the subscription amount raised. 20,000 I raised, it was my company's value will increase by 20,000 theoretically divided by post right number of share is pre-right share plus the rights which are the number of shares which are issued. So N0 plus N1. Overall, pre-right market value is P0 N0. Subscription amount raised is basically P1 and 2 and 1 divided by existing share plus the new share. Do you agree the total market value after the right is distributable to total number of share? There is nothing called as new share, old share. Everything will be one share only, like one category, one type of share. N0 plus N1 in the denominator. Existing value 100 into 1000 plus new 250 share of 80 each, which means 20,000 is the increase in value divided by existing share 1000, new share 250, giving me the price after the right theoretically in the market should be 96. Meaning to say price here was 100. If I issue one share of 80 rupee against every 4 shares, the price here will be 96 is the concept I am trying to teach to you. This price is come right price so far. After the rights issue, the price is called as X right price, post right price. At 0 point, as an investor, it's not compulsory that you buy the rights. You have a choice to sell that right. I gave an option. At this point, if you don't want to buy it for 80, sell it to someone. But when you sell it to someone, someone will have to pay a value to you. What is that value? Very simple logic. You are giving someone a benefit. What is that benefit? The benefit is that something which is going to be of become 96 tomorrow, that someone can buy from the company at a price of 80. Do you agree? The share price which will become 96 tomorrow, today the same share can be bought by the other person whom you are selling the share at a price of 80. Sir, is it a 16 rupee of benefit that other person will have? Yes, agreed. So maximum price that he should be ready to pay to you is 16 rupee, which is not a formula that X right price minus issue price is a common sense that price tomorrow will be 96 and the same share you can buy for 80 through this option. So you can maximum pay 16 rupee for that option is the value of right. But the 16 rupee of right you got because you had 4 shares. Ratio was 1:4. 16 rupee of right which you can sell you got because you have 4 shares. So in every 1 share, how much is the value of right integrated? 16 divided by 4 give me value of right per share is rupee 4 per share. The last calculation you need to learn in this is the calculation of gain loss to the shareholder. Suppose there is a shareholder holding 100 shares. So 100 share of rupee 100 I am holding, the total wealth I have is 10,000. Suppose 3 possibilities. With the ratio of 1:4, when the rights are announced, I can either subscribe it, renounce it, ignore it. If I subscribe, I will have 125 shares then, right? Where price per share will become 96. So my total wealth become 12,000. But do you agree to buy those 25 shares? I must have paid 80 rupee of cash. Per share issue price was 80. So 200,000 will go out of my pocket and my net wealth will be 10,000. Sir, if I renounce, I will continue to have 100 shares. At a price of 96, wealth become 9600. But those 25 rights, when I sell to someone at a price of 16, as you observe, sir, I will receive 400. So my wealth will again be 10,000, which means if you subscribe, if you renounce, wealth remains same. However, if you ignore, the wealth decreases. Because 100 shares you have of 96. Those rights, neither you subscribed nor you sold, you lost that amount, and 960 is the decrease in wealth, losses in ignoring. Which gives to you the learning that if you ignore someone, what can be the implications you can have, okay, when you ignore someone. So now if you ignore me by not putting a like to it, this video, or maybe by not putting a comment to this video, then you may be at loss. Well, jokes apart, everyone in the class, fun apart, this is the entire discussion on right that you have done. Basically, if you realize, you have solved a practical question only on this. So let me also take a question in the class for that you have, so that you have one question of each type, each variety at least. A very logical question, let's say question number 81. ABC company's share currently selling at 13 rupee P0. There are 10 lakhs such shares. Fine. Firm is planning to raise 20 lakhs to finance a new project. I need 20 lakh rupees. What is the X right price? What is the price immediately after the right, and what will be the value of that particular right at which you can renounce it if firm offers 1:1 for every 2 share? So as I said, ultimately I need two things: new shares to be issued and the price at which they are issued. 10 lakh share 1:2 ratio give me 5 lakhs as new share issued. 20 lakhs amount raised, 5 lakh number of share, price per share to be issued is 4. So 5 lakhs and 4 is the number. Now post-right market value has a rhythm, is not a formula, has a rhythm. Don't mug it up, please feel it. Existing value plus value due to right divided by existing shares plus new shares due to right will give you the post-merger MPS, post-right MPS. Existing market value is 10 lakhs into 13. New market value is 20 lakhs. That will be added because that cash is raised. Divided by existing share 10 lakhs plus 1:2 ratio give me 5 lakh new shares. When you solve it, the post-right price is 10. The price which is right now 13. When a share is issued at rupee 4, the price will become per share 10. Now when you go to the market to sell that right, you go to the market to sell that right. So it's like something which is going to be 10 tomorrow. The same share you can buy at rupee 4. I have that right. So how much is the maximum advantage which can be felt is rupee 6. 6 rupees the value at which you can sell, 6 rupees the value of right you have. But that right you get from every 2 shares. So how much is the value of right integrated in 1 share? 6 divided by 2 give me value of right per share as 3. So when the examiner says value of a right, you try to calculate both value of right plus value of right on a per share basis that you do. So if the ratio is 1:2, this will be the value. If the ratio is 1:4, what will be the value that you do at your own? And using 100 shares, you have to calculate gain loss. Assuming subscription. If the examiner is silent, assume the right shares are subscribed and calculate the change in wealth. We all know already there will not be any change in wealth. The well will continue to remain the same. Question 81, a basic question on the rights gets done because a similar question we have already done in the out notes. Next concept, people in the class, you all need to learn is the concept of buyback. Concept of buyback is really easy, but the questions Institute unfortunately asked are a bit typical reverse calculation based questions. Yes, just give me a second. We are on the last second topics. In maybe the next 15, 20, 30 minutes, the video will get over. So please remain calm. Please remain attentive is an important thing we are learning because institute ask a practical question on this. Okay, give me a minute. So come on, let us proceed. Fine, everyone, cool. Buyback. When I need money, me as a company, I issue the share, raise the money. But if I have excess money, I want to do the process otherwise. Rather than issuing the share, I want to buy the shares back from you. But when I buy the share back from you, I have to pay you a price. The price I pay you is called as buyback price. The buyback price generally is more than the market price. See, when it comes to the price at which I issue the share to you is a price lower than market price. If the market price is 20, I come to you to issue the share at 25, will you buy? No, I'll have to issue to you at 15, then you buy. But similarly, buyback. I want to buy back a share from you. Market price is 20. If I offer 15, will you be ready? No. If I offer 25, then you'll be ready, which is why the buyback price is generally higher than the market price. First. Second, sir, total how many shares will I be able to buy back depends on two things. First, how much is the total amount available with me using which will be used for buyback? How much is the total amount I'm ready to pay to all the shareholders? Divided by what is the price at which every share will be bought back? Buyback price. So buyback amount divided by buyback price give me the number of shares which are bought back. Logical? So how much will be the number of share after buyback, post buyback? Pre-buyback number of share which I already had minus the shares which are now bought back give me the post-buyback number of share. This seems logical. Sir, where would the buyback amount come from which the company is ready to give to the shareholders and get the shares? Sir, either the company has surplus fund with itself which it will give or it has borrowed the amount. In both the case, after the buyback, company will have the loss of interest. If there was a surplus, company was earning money, now it won't be able to earn because surplus is gone. If the company makes fresh borrowing, then the interest will be needed to be paid, meaning to say from the future earnings of the company, there will be loss of interest, whether it's lost or it gets paid. Sir, after buyback EPS is a simple thing, after buyback PAT divided by after buyback number of share. After buyback number of share is easy. Pre minus bought back share. After buyback PAT is also easy. Whatever was by pre-buyback PAT will be there. But now there is an interest to be lost or paid with the effect of tax will be post-buyback PAT, calculating post-buyback EPS. Next is post-buyback market value or market price. Post buyback market value is post buyback number of share multiplied by post buyback market price. Such a common sense. MPS into N give me market value. Everything is post buyback. Similarly, post buyback MPS is post buyback EPS into post buyback P is a common sense. Sir, the formulas to be used to solve the practical question are actually so basic. But the questions framed in the exams are a bit typical or maybe difficult, I can say. We'll do two practical questions of this. One is question 85 and next is question number 87. So let us first of all do question number 85. People in the class. What it says? It says that Rahul Limited has surplus cash of rupee 100 lakhs. It wants to distribute 27 of it to the shareholders. So I have 100 lakhs, but I would distribute 27 lakhs out of it to you. The total buyback amount I am ready to pay to you is 27 lakhs. The company decides to buy back. Finance manager estimate that share price after buyback. After the buyback, there will be a share price in the market. Fine. It is 10% above the buyback price. I decide to buy back at a price. For example, 100 rupee. For example, after the buyback, price in the market will be 110, which is 10% extra. Cool. Fine. Now, what is the buyback price? That I don't know now. Number of share outstanding at present is 10 lakhs. EPS right now is 3 lakhs. So before buyback number 10, before buyback EPS is 3. You are required to determine the price at which shares can be repurchased. The price at which shares can be repurchased means shares can be bought back if the market capitalization should be 210 after buyback. Sir, what is given? I'm not able to actually process it. The price at which share can be repurchased, isn't it the buyback price they are asking? Which means buyback price is not given, they are asking me. Okay. Market cap is 210 after buyback. So whenever there is a reverse calculation question, I always ask you one thing, that write down the formula of what is given. Post buyback market cap is 210. Can I say it is simply post buyback number of share multiplied by post buyback MPS? Agreed, sir. Fine. They say after buyback market price will be 10% above the buyback price. Post buyback price, market price will be 10% above the buyback price itself. If I assume the buyback price to be X, which the question has asked, can I say post buyback price will be 1.1x? Okay, sir. What about post buyback number of share? So pre minus the share bought back is the post. Pre is 10 lakhs. Let's find out the number of shares bought back. Sir, if buyback amount is 27 lakhs, divided by 27 lakhs is the total amount I have to pay to you, where per share I am ready to pay you X. How many shares will I be able to buy back? 27 divided by X the shares to be bought back. The post buyback number of share will be 10 lakhs minus the share bought back. Post buyback number of share multiplied by post buyback price is the post buyback market cap. In this entire equation only one number is missing, which is people in the class X, the buyback price that you calculate. The first part of this question was really typical to solve. Next is easy. How many shares you can buy back? 27 lakhs divided by 21.79. So 123,910 lakhs. That is also fine. Impact on EPS, assuming net income remains same. Previously net income was 10 lakh rupee into 3 shares, so basically 30 lakh rupee income. It will remain same, there is no loss of interest is what they are saying. Divided by now the number of share will be 10 lakhs minus the share bought back, giving you EPS of 3.42. An easy part 85th gets done. When they ask impact, you will have to also say in theory, in words. The EPS will increase from this to this or this to that, something. That was people in the class question number 85th. Are you people requesting your responses? Please, 100% settled with question number 85th. What do you all say? Come on, tell me. 85th. Next question you're gonna solve is 87, for which I will show you a good presentation in the handmade notes. 87th, which is otherwise a complicated question. Really. Gets easy presentation in our handmade notes. Look at this one. Look at this one. Yes. What it says, people, what it says that SM Limited has a market cap of rupee 3,000 crore. Market cap of the company given. Current EPS is 200 rupee. Fine. P ratio is 15. So if EPS and PE is given,